It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know today, starting with some movement that we're seeing in the market.
That's right. Yeah, stock futures this morning are mixed as the major averages are coming off of a negative session as escalating tensions in the Middle East spark fear of a wider conflict. Oil prices rising again this morning as traders brace for possible supply disruptions. Wall Street also tracking a strong read on the labor market this morning. And, of course, the ongoing port strike.
Nike is looking for a fresh start under its new CEO. The footwear giant withdrawing its full-year sales guidance and postponing its investor day. That was originally scheduled for next month in November, citing the leadership transition. Nike veteran Elliott Hill, he will become CEO on October 14th and embark on a turnaround mission for the company. Shares down about 18% since the start of the year.
And Tesla sales, we're tracking those this morning, expected to rise in the third quarter compared to the prior year. The anticipated growth likely boosted by demand out of China. A subsidy there encouraged drivers to buy electric vehicles. Wall Street is also going to be looking out to Tesla's big robo-taxi event. That comes this month, October 10th. Shares are up just 4% so far in 2024. Our top story today, investors weighing a slew of headlines from strong jobs data to escalating geopolitical tensions and the ongoing port strikes. Nearly all asset classes are responding here, and we've got a look at the U.S. futures here this morning that are in decline, slipping for the Dow, the S&P 500, and the Nasdaq in the red, fractionally as they may be. These are some major events to really dive into, and that investors have been weighing over the past 24 hours here. Of course, some of the most recent jarring moves have really come off the back of the news yesterday surrounding the geopolitical tensions. And this was actually something that we heard from Alex Karp, who is the CEO of Palantir, back on their earnings call in August. You heard about all these exogenous threats and what that could look like. And he had said on that earnings call, the world is on the precipice of what could be a very severe set of violent interactions in the Middle East. That's just what's playing out right now. Markets responding.
Yeah, certainly did see a flight to safety yesterday. I think we're coming off the back of some of those highs here this morning. But when you take a look at oil markets, this is really worth pointing out. This jump that we did see yesterday was a 5% jump to the upside. Today, this morning, we're looking at a further 3% move to the upside. And the big concern here is the disruption, the supply disruption, what exactly that could look like amid tensions in the Middle East. And remember, that is not the only headline, though, that is driving this upward movement that we have seen in the price of crude lately. You also got the stimulus out of China last week, strong global liquidity. That might help reverse some of the weakening that we have seen in oil prices. So again, the move to the upside here in commodities. Also, gold is worth watching as well. So certainly some trades to keep in mind on the back of this heightened geopolitical risk. Yeah,
that's exactly right. And one of the areas that investors typically look towards is we're thinking about some of the sectors here. I know you were focusing in on utilities. One of the areas that I'm focusing in more broadly is those defensive plays, defense names. You've got names like Northrop Grumman, who we brought up yesterday on the back of and on the heels of the initiation of some of these strikes here in the Middle East. Those in focus here this morning. You're seeing them continue to catch a little bit of a bid here pre-market. Fractional as it may be, you're taking a look at Lockheed Martin moving higher by about 0.2%. Northrop Grumman up right now by about 0.3%.
All right, well, traders are bracing for further disruption in the Middle East as Israel vows to retaliate against Iran's Tuesday's missile attack. Oil prices surging for a second day on supply concerns, while the S&P futures slide for a second day. Joining us now, we want to bring in Ed Mills. He's Raymond James' Washington policy analyst and managing director. Ed, it's great to have you. So I'm curious, as we just take a step back and try to figure out what exactly this means on a global scale for the economy, what is your initial read just on these heightened tensions that we're seeing play out in the Middle East?
Yeah, Shauna, I think the initial read is that we need more information. What we have seen is over the last couple of years, a market in a global economy, in a U.S. economy that have been shockingly resilient despite global tensions rising. When I talk to our energy team here at Raymond James, they have highlighted record U.S. energy production as one of the ways in which it's insulated, the abilities for other producers such as Saudi Arabia to come online if necessary, and the fact that despite a lot of geopolitical risk, the physical supply of oil globally really hasn't been impacted. There are a lot of unknowns ahead, and Israel will absolutely respond. They cannot let hundreds of missiles going towards their country be met without a response. But the history of the last couple of years is that we have short-term spikes and longer-term things settle down.
What do you calculate that response from Israel may look like, Ed?
It's uncertain just yet, Brad, but when I looked at the statements of Prime Minister Netanyahu, it seems very clear that Israel feels as if a strike against the nuclear capabilities of Iran and their nuclear program is absolutely at the top of their list. They've talked about targeting key officials potentially within Iran. You have Israel, who has been systematically over the last year since the terrorist attacks of October 7th, looking to go after proxies. You've seen that with Hamas, Hezbollah, now more directly towards Iran. So more direct strikes inside Iran, I think it would be the next step, especially since you had direct missiles coming from Iran yesterday over to Israel.
Well, then naturally the next question becomes, and as is always the case with geopolitical tensions, is there spillover or is there containment from your assessment thus far?
Yeah, I think it is still too early to tell. What you look at, and I think a big wild card here, is what is the U.S. response? What is U.S. involvement? There are personnel in the area. There are submarines in the area that have been announced. So the spillover effect kind of will depend a little bit on the U.S. response, as well as other actors and other countries within the region. You have a number of countries who would like to de-escalate. There is a lot of pressure on Saudi Arabia to become involved here, potentially be an off-ramp. And I do think that what we've seen over the last year is getting close, but not crossing the line over ceasefires. And there's been an expectation recently, you probably need to see an escalation before you can de-escalate. So if there is any silver lining people are looking for, is this escalation that potential start of an off-ramp to de-escalation? I think it's a little bit too early to call that just yet, but that's, I think, what the market will be looking for. Because if the market sends any de-escalation, any ceasefire, that will be received very positively.
So, Ed, we have the Middle East tensions. That is something that's going to be front and center ahead of the election just next month. But then you also have bringing it back home and some of the domestic headlines that we have been tracking. Obviously, the port strike front and center. We heard from both candidates last night just in terms of their economic policy, some things that they outlined. I'm curious, though, how you're looking at this from a political play and whether or not you see this being a huge headwind here for the Harris campaign going into November.
Yeah, Shauna, I think it's most conversations I've had at Raymond James has been the expectations on this port strike within the market is that it lasts about a week before it gets resolved. If it's materially beyond a week, I think that's where the market starts to react. And I think that's where we start to have the conversation about the impact to the election that is now about a month away. When we look at the data in voter sentiment, we see about 70 to 75% of voters say that the country is on the wrong track. That generally speaks to a potential change election. And then the debate is, who is the change candidate? Is it former President Trump, or is it kind of Vice President Kamala Harris? It was a clearer kind of change where Trump would get that benefit if it was Biden versus Trump, because obviously Biden is the incumbent president. Any disruption to the economy, any further geopolitical risk, I think you would have to say that on the margin is a benefit to the Trump campaign, and a question on whether or not you put these together and have a surge at the end for Trump, which is what we saw in 2016 and 2020. And that's why I think when we look at this election, we think it is so close, and some of these known knowns and some of the unknown unknowns still with a month to go could be determinative as to who wins the presidency.
We know that just a 1 week strike, according to analysis by the Conference Board, could cost the U.S. economy about $3.78 billion. That's what it sounds like you're in alignment with. If we do see this spill out furthermore, where are some of the other, especially as investors are tracking how the companies that they may hold in their portfolio are annexed or impacted by this, where could you see some of the other permeation if we did go beyond 1 week?
Yeah, I mean, it's a kind of conversation about the supply chain again, Brad. We experienced this recently that when we had a slowdown in the supply chain, how that impacts the consumer, how that impacts inflation. And that's why I did say that if we have it prolonged, it is a kind of needle mover in the direction of former President Trump. I do know that there has been a lot of anticipation that this port strike was coming. So I think businesses have insulated themselves for a couple of weeks. And if it does go much beyond a week, what I'd be looking at is, does the president invoke his authority under Taft-Hartley in calling for a cool down period? Now, I don't think that's a panacea, and I don't think anyone wants to see that happen, because what we've seen is the president of the Longshoremen's Union say, all right, if we have the president invoking that, it would be a significant slowdown. So that probably at this time prolongs everything. And so having this pressure build right now, trying to get that contract negotiation done is in the best interest of all parties, in my opinion.
Yeah, since the 1970s, that's only been used once to end a work stoppage back in 2002. Ed Mills, Raymond James, Washington policy analyst and managing director. Ed, thanks so much for taking the time this morning.
Thank you.
We've got a fresh read on the labor market this morning. Private sector hiring, it picked up last month, showing some strength in the labor market despite recent signs of weakness and weak pockets. Yahoo Finance markets reporter Josh Schaefer has the details here. Hey, Josh.
Yeah, Brad. So the ADP report showing private payrolls, 143,000 ads in the month of September. That is up from 99,000 in August. So a pretty big jump there. ADP chief economist Neil Richardson, on a call with reporters about a half hour ago, said that she thinks this shows that the labor market's pretty healthy, and this is a widespread rebound that we're seeing in hiring, essentially arguing this fights back against the narrative that we are rapidly deteriorating. If anyone was sort of in that camp, data like this kind of hurts that narrative. Also within ADP, they have this thing called pay insights, right? So it's the insights for people that are leaving jobs or staying jobs and how much they're making compared to last year, their wage growth. She pointed out that for people that are leaving their jobs, it would pay growth fell to 6.6%, the lowest level in about 3 years. And she said when you take this and you look at something like what you guys were talking about yesterday with the JOLTS data, you're seeing the quits rate really low, right? Right now, people don't really want to leave their job. Well, they don't want to leave their job because they're not really making that much more money by leaving their job versus staying in their job. She said this puts the labor market in kind of a ideal equilibrium, a phrase we're hearing a lot right now with economic data. And she said, of course, the question is, how long can we stay in this equilibrium? But for now, it's a solid spot where workers should be relatively happy. They're making 4.6% year over year wage growth. Not bad.
Yeah, it isn't bad, especially when you put it in the context and you compare it maybe to some of the slowing inflation that we have seen, at least in recent months. But Josh, I guess my question, and pushing this forward as we look ahead to Friday, we haven't really seen necessarily a strong correlation, although I guess it's gotten a little bit stronger here over the last couple of months, between the ADP print and non-farm payrolls, which we're going to get on Friday over the last couple of years. But do you think this at all changes the calculus or outlook or optimism heading into Friday, maybe making it a bit stronger given the beat that we saw this morning?
I mean, look, you're right that we haven't seen a total correlation, but last month I do think there were some people in the economic community that took the weak ADP print to spin a jobs report that you probably could argue was weak or strong. It was kind of a toss-up, and they were like, well, the ADP data was bad too, right? So there's another drop in that bucket. If we're calling it a drop in a bucket this time around, it's probably a drop in the labor market's doing okay bucket. So if you have a mixed jobs report, now you have some other private data that supports it being solid. I think the read and sort of the reaction to this ADP report, we just showed the numbers for the expectations for September for Friday. If you get about 145,000 job ads, if the unemployment rate doesn't move at 4.2%, I think that's a solid read. That's what economists expect. It's anything that comes in, if your non-farm payrolls are significantly lower than that, if your unemployment rate goes up, that's when you're going to start to have discussions about, okay, is this slowing more than we thought?
All right, Yahoo Finance's own markets reporter, Josh Schaefer. Thanks so much.
Our very own.
I mean, was that your laptop that was playing this in the makeup room? You were listening into the call?
I was listening in, Brad.
I was like, whose laptop is that? Going off, just full volume?
Doing the reporting for you, Brad.
Always.
Good stuff.
Making the calls.
Always on.
Excellent work, even when he was getting powder on his face. Thanks so much. We've got some breaking news out. Tesla out with its latest delivery numbers. The EV maker reporting it delivered 462,890 vehicles during the third quarter. That's slightly below the street's expectations of nearly 464,000 deliveries here. And so even as we're taking a look through the stock reaction, shares retracting here, retracing by about 3.4% pre-market. And just to reiterate the breakdown here, for the deliveries, 975 deliveries. And that is for the Model 3 and the Y. Of course, that makes up typically the lion's share between those two vehicles. Of course, 75% of the Model Y is essentially a Model 3, so a lot of production synergies that they rely on there to make that happen. But looking through that other models as well here, 22,915 other models delivery. This is like the X, the S, the X. This is the Cybertruck even that's encapsulated within there. So interesting. Once we get to this earnings call that comes forward with this in mind, what the type of breakdown or any additional color that they might add around the breakout of those vehicles could look like.
Yeah, and you might be asking yourself the question as to why we're seeing the stock move so much lower here. Essentially, yes, they came in a bit light, but they did pretty much be here when you take a look, or excuse me, pretty much meet expectations when you take a look at those headline numbers. A very, very, very slight miss. And I think the reason that we're seeing such an extended reaction here in the pre-market is because of how the stock has performed here over the last couple of months. You're looking at a 3-month gain of just about 30%. You're looking at a 6-month gain of about 46%. And I've been going through a number of analyst reports and expectations ahead of this release here this morning. And they were very optimistic about what we were going to hear from Tesla. So the fact that we did get deliveries at 462,000, just slightly below Bloomberg estimates, I think that is enough to spark some concern that you're seeing play out on the street here this morning. I do want to note, though, if you're looking at a positive view of this report, this was the first quarter of growth this year. We saw sales increase 6.4%. We've been talking about what has been helping Tesla here as of late, the last couple of months, China boosting its subsidies for electric cars. That is something that's been cited time and time again here from analysts, that they expect that to continue to help Tesla here going forward, regain some of that momentum. So like you were saying, I think we will be looking ahead to that earnings print, to that earnings call that will be coming in a little bit, just for any more color on some of that demand that they're seeing and also what those projections look like. All right, well, coming up this hour, we count you down to the opening bell on Wall Street as investors grapple with geopolitical risk. Plus, Nike withdrawing full-year guidance and postponing its investor day, what a clean slate means for the incoming CEO. And we'll bring you more on Tesla's third quarter deliveries out this morning as shares sink to the session list here in pre-market, looking at losses of just about 4%. We've got all that and more coming up on Morning Brief.
Now time for some of today's trending tickers. You could scan the QR code below to track the best and worst performing stocks of today's session with the Yahoo Finance trending tickers page. First up, we've got to go to the swoosh. Nike withdrawing its full year guidance and postponing its investor day scheduled for next month ahead of Elliott Hill taking over as CEO. The company reporting mixed first quarter results, beating on earnings, missing on revenue. Joining us now for more of a read on this, we've got Baird's senior research analyst, Jonathan Komp. Jonathan, great to have you here with us. Just break down the tenor that you heard from the company pulling some of their guidance here. It was essentially kind of a look across the board and saying the environment is competitive and it's going to take some time for them to really make inroads and expand market share at this time. What do you make of that?
Thanks, Brad, for having me on this morning. This really was a transitional quarter for Nike. The call itself was led by the company's CFO. And as you mentioned, I think we're now 12 days before incoming CEO Elliott Hill is set to join the company. I think the results, if you look at revenue down 10%, earnings down more than 25%, really highlight some of the pressures in the business currently. You see Nike taking proactive actions to reduce classics footwear inventory in the marketplace. That's had a significant hit. And then, frankly, you've seen lower than expected unit demand in a couple of places. The company called out back to school in North America, as well as the retail conditions in China, both as some incremental challenges. So maybe no surprise that you see the reaction from the stock today. We did lower our forward earnings by about 10% overnight here, but really we're focused more on the outlook ahead as new leadership starts to take over.
And Jonathan, what is it about Nike's playbook that's getting you excited? Because your note out this morning was called titled Positioning for a Comeback Story. I guess why don't these weak results and some of those trends to the downside that we've seen, why isn't that deterring you at all?
Yeah, it's a great question, Shauna. I think a couple of things that we try to factor in. First, generally, we expect stocks in the sector to bottom when earnings start getting less bad. We think we've seen the worst here for Nike, but it is going to take patience looking forward. We think Nike, over the long run, still has exceptional brand equity and value. We think the last 4 years really have been clouded by misexecution on a number of fronts. And new CEO Elliott Hill really is more of an insider than not. He's a 32-year veteran at the company. I think he's very well liked. The positive signals are pretty clear from an internal perspective, and that's important for a company that's not used to being on defense. As we look forward, the company already is taking actions to build the innovation pipeline. Really performance innovations, what has led Nike out of past challenges when you look over the past few decades. We expect that pipeline to start to build in 2025 and beyond. And when we look today, the earnings look very depressed and we think have significant upside potential. So forward-looking investors who are willing to be patient and see the potential benefits under new leadership, we think can be rewarded by starting to take another look here.
It's really interesting, Jonathan, because when we think about performance innovation, that typically comes with a cost premium for any athletic apparel and footwear company. And so you still have this backdrop of a consumer that is being very choosy about how they're spending and what they're spending on. How difficult is that going to be for Nike to make sure that they are striking the right price and making sure that any innovation that gets put into the market for consumers is actually appreciated and is actually recognized in sales?
Well, you're exactly right. We do see a challenging near-term environment. We've seen consumer spending slowing pretty consistently across the board. In addition, Nike's not operating in a vacuum, and there's certainly lots of competition. We see that from Adidas. We see that from some of the upstart brands, whether it be Hoka or On. So it's a competitive category. The good thing is we do think the category can continue to take share over time. We think Nike can regain its leadership position. And if you look over the last few years, really, Nike's become a bit unbalanced. We think there's significant opportunity left on the table, re-engaging wholesale partners, and especially some of those that cater to lower price points specifically. So we think there's opportunity across the board for Nike, but it has to start with product, and it's going to take some time to scale that back up. And when they do that, we expect it to come really across price points. So that should address multiple consumer categories in the marketplace.
Just lastly, while we have you here, as you think about Nike's history, it hasn't had a rich acquisitive history, but very strategic. And in periods like this, and some of that has meant divestitures over time. Do you think that this is a company that needs to make a strategic acquisition in order to bring on more market share for its business?
Yeah, it's a great question. Certainly a typical playbook for others. I think for Nike, focusing back on the core business really is the right move here. If you look at our forward projections here, we're essentially modeling profitability back to 2016 levels. And that's despite a company that's now nearly 50 billion of revenue versus closer to 30 billion back then. So we think there's significant potential just by being a better run company, getting back to higher profitability and resonating more with the consumer. That's, again, going to take time, but really nothing that we see that would require acquisitions in terms of bringing on new brands or capabilities.
Jonathan, how are you looking at the port strike right now, and even just beyond your Nike coverages in the broader retail space? How big of a risk? I guess at what point in this strike will you be getting a little bit more worried about what this means for pipeline, what this means for product and supply here over the next several months?
Yeah, well, I do think Nike highlighted last night. It's certainly a watch factor at this stage. I think the good news is, at least for holiday, typically most goods are delivered and in place by the end of September in order to be on the shelves for the holiday period. So in the short term, we don't see a whole lot of disruption, but that is going to depend on duration and degree of impact. I think if this stretches on for weeks and months, or the longer it goes on, I think the more risk you could start to look out forward to spring 2025 deliveries. So that's certainly something to watch. I think all of our companies typically sourcing in footwear and apparel has done more across Asia, and all of these companies have really developed a better muscle in terms of flexibility over the last few years, given the global supply disruptions we've seen. So we're hopeful that ongoing impacts for footwear and apparel can be relatively minimal, but again, it's something to clearly watch pretty closely here.
All right, Jonathan Komp, great to have you here. Thanks so much for taking the time to join us, Baird's Senior Research Analyst. Thank you.
Thanks for having me.
Disney consolidating some of its TV show teams, eliminating about 30 positions as part of a cost-cutting plan. This follows about 300 corporate jobs that were cut last week, and we know there's been ongoing streamlining impact on Disney here over the last several months, really just beyond the last several weeks at Disney's. Actually, in recent years, the company has eliminated 8,000 positions, so we know they have been looking to streamline some of their teams. Disney out with a statement saying that, like the rest of the industry, we're examining every facet of our business, including how we need to organize our business segments. They also went on to say that in addition to streamlining our approach, these changes will aid in bringing our linear and streaming creative teams closer together. So again, we are seeing some downward movement here in the stock this morning, off just about 0.5%. And I think the street's just trying to figure out what exactly the road ahead looks like for Disney. We have a number of these cuts, a number of these strategic initiatives that are underway right now. Iger's still at the helm. Questions about what exactly, who his successor is going to be, what Disney is going to look like under a new successor. And also remember that we had the Raymond James cutting its recommendation earlier this week to market perform. So there are a lot of questions out there on the street, at least over the next couple of quarters, about what exactly some of those challenges and the impact some of these challenges are going to have on shares.
And then also we want to take a look at Conagra this morning, ticker symbol CAG. Let's load up the chart here. For Conagra Brands, they missed first quarter sales estimates. Weak demand, packaged food company taking a hit as consumers look for lower prices here. Shares down pre-market by a little more than 8%. Reported net sales, they decreased 3.8%. Organic net sales decreased 3.5%. Company did reaffirm its fiscal 2025 guidance, but it's not great guidance. Organic net sales are expected to be down 1.5% to flat compared to fiscal 2024. The CEO perspective that they did provide as well, saying that this was continuing to be a challenging environment. Domestic retail volume progressed in line with some of their expectations, and they did increase some share across the portfolio and advance their portfolio reshaping initiatives. So all that considered, it's just important to think about the broader kind of backdrop of this, that 3.5% decrease in organic net sales driven by a negative impact from price and mix. And they said that was also largely driven by some of the strategic investments in the quarter as well, plus a 1.6% decrease in volume. Shauna?
All right, Brad, we have the opening bell here ringing in just about 5 seconds as we take a look at futures. You have S&P futures under a bit of pressure here as we open today's trading day. Dow futures, though, just above the flat line. It looks like the Dow is going to open in positive territory. You've got the Nasdaq calibrating right now as we ring the opening bell at the Nasdaq and the New York Stock Exchange. Of course, the big focus for investors this morning is that ADP print stronger than expected, but ultimately that could mean ahead of Friday's big jobs report. And then we also had the rise in geopolitical tensions, the Iran missile attacks yesterday, just exactly the risk, that the heightened geopolitical risk that obviously viewed as a potential risk here to the broader markets as investors we've seen a bit of a flight to safety here over the last 24 hours. But taking a look at the S&P here this morning, you're looking at a loss of just about 0.2%. Taking a look at the Dow, actually opening just below the flat line here, and the Nasdaq also under a bit of pressure this morning. I mentioned the heightened geopolitical risk. I want to pull up crude right now. Oil on the move to the upside for the second day in a row. You're looking at gains of just about 3% here this morning. Over 2 days, you saw a move here yesterday of about 5%. So you can see that upward movement here in the price of crude just above $72 a barrel. And as we take a look at the equities market on a sector basis, some of that movement that we're seeing here this morning, you've got energy, the only sector here in the green as we kick off today's trading day, up just about 1%. On the flip side, real estate and consumer discretionary lagging. Let's get over to Yahoo Finance's Jared Blickery for a closer look at some of these movers, Jared.
Well, thank you, Shauna. Let's check out the S&P 500 right now, and you can see it's starting out on a little bit of a down note right here. This is a 2-day chart. I'll put the year-to-date up so you can still see that it's up 19%. And in fact, we just closed the last quarter up 20%, and Ryan Dietrich ran the numbers and has an interesting stat for us. S&P 500 up 20.8% heading into October could mean that we finally see some red, with October lower 7 of 9 times when stocks were up 20% or more heading into this spooky month. This isn't a bad thing, though, as Q4 tends to still rally, and we'd expect this to play out again in 24. So we could see a little bit of a downdraft this month. This is one of the highest average VIX readings that we get, and that just means that it's kind of a crash season. Not that it has to happen, but the markets are prone to that. So let me get back to our charts here. Give me a second, and I'm going to check out the dollar because I've been watching that closely, and we're seeing that jump a little bit. This is a third day straight, and it's important because this could be forming a base that would allow it to launch higher to some of these highs that we've seen there earlier in the year, and that would just be negative for stocks potentially. Got to get to the sector action. It looks like tech has flipped into the green, but energy leading. Consumer discretionary is lagging. And Shauna did an excellent job with crude oil. I was writing about it in the morning brief. I'll just say, here's a 3-year chart. If we're at the bottom end of this range, we got a potential upside here that's pretty big. 80, 85, maybe even 90. Also, gold is consolidating near highs, but I also want to show RBOB gasoline futures, which actually dipped below the $2 level and are just consolidating there, but I think RBOB is going to be my leading indicator for energy. It pops and it keeps above $2, well, I'm bullish. Below, I'm bearish. And got to check out China because China has been on an absolute tear. This is just what happened today. I'm going to show you the trailing month here and just look at some of these returns. I'll sort by return. We got one up almost 350% UXIN. Then we have a number of these going all the way down to JD.com on the right. That's up 70%. I'll close here just by showing our aerospace and defense board. That is another sector where we've seen a lot of gains. And here is what's happening today, giving some of those back, guys.
All right, Yahoo Finance's own Jared Blickery out there breaking down all things across the board at the market open here. Thanks so much, Jared. Coming up, everyone, are investors placing too much hope on the Fed's soft landing outcome? We'll discuss that next on Morning Brief. Time now for today's strategy session. Our next guest says that investors are heavily investing in the Fed's ability to achieve a soft landing, and she's not so confident that they can pull that off. Joining us now is Megan Horniman, who is the Verdence Capital Advisors CIO. Megan, great to have you back on the program with us. Why the cold water on the soft landing prospects here?
I think that, I think people are just getting a little ahead of themselves as far as what strength there is in the economy. I understand the labor market still remains relatively strong. I mean, we've seen an increase in the unemployment rate, but it still is relatively low. The consumers, although they're spending on credit, and this is a concern for us. So eventually the consumers are going to run out of steam. Credit card rates are still very high. And when you're looking at over $1 trillion in credit card debt, this is a concern for us from the consumer standpoint. And we know that inflation is coming down towards the Fed's target, but we can't forget that this has been accumulating for several years now. So this is really a strain on consumers. And if you look at some surveys, most Americans actually think we're already in a recession. That's how poorly they feel. So I just don't see the strength in the consumer that's going to be able to last much longer.
So then how does that translate for equities then? What does that downside risk look like for markets?
I think the equity markets right now are just too optimistic on the entire scenario that the Fed will articulate. I mean, be able to deliver this perfect soft landing. They'll continue to cut rates. I think that the equity markets are just getting too complacent to that perfect scenario. If you look at every other economic indicator aside from the actual GDP number, all of these things are looking like they're in a recession territory. Look at leading indicators. Look at manufacturing. We'll get the service index this week. All these things are showing that the economy is weakening.
So, Megan, but what does that mean, though, I guess, more specifically? Are we talking about a 3 to 5% drop? Are we talking about 5 to 7% drop? I guess, how dire could the situation get?
I think you could get even another 7 to 10% drop. I mean, we had a 7% drop, I think 7 to 8% drop a couple months ago, and I think you could see that occur again. I just think there's not enough confidence that I have in the earnings expectations for next year, and we haven't seen earnings really be revised much lower, even with the fact that the economy is slowing.
How much different is they've successfully pulled off, or it looks like they're going to pull off the soft landing portfolio playbook versus they have no shot of pulling off this soft landing, and you should actually be looking for and anticipating a recession? How vastly different are those two investor playbooks?
Well, if you think that it's going to be hard for this soft landing like we do, then you want to have extra cash to be able to put to work. Because eventually, even if there is a pullback in the economy, we will come out of this. You want to have the dry powder to be able to put to work during that downturn. That's when you're going to want to invest in things like small caps, mid caps. You're going to want to look internationally as well. These are things that there will be opportunities when the equity market starts to kind of get realistic on what the economic outlook is.
So, Megan, how does this all translate then for the Fed? If there is this risk here that maybe the economy isn't as strong as some investors are pricing in right now, maybe consumers are a bit weaker than many realize, does that mean that the Fed should go 50 at its next meeting?
No, I don't think so. And the
Why not?
problem the Fed has is they're walking a very, very fine line. They seem to have kind of forgotten completely about inflation, and that's a concern that we have. They're focused very much on the labor market right now, but you cannot forget about inflation. Inflation is still out there. It is coming down towards their 2% target, but there's a lot of areas of inflation, whether you look at housing, whether you look at services. This type of inflation is still running well above the Fed's target. Then you throw into the mix this port strike, and what is that going to do to inflation? So the Fed's got to be very careful. I think that they'll probably deliver with 25 basis points, but I'm not surprised that we saw a little bit more of a hawkish tone from Powell last week. He's got to get the markets to be a little bit more realistic on what they have the ability to do. Remember, they want to be transparent. They don't want to be in this stop and go scenario like they were in the 70s and 80s. So they have to be very careful and walk this very fine line with how they deliver these rate cuts.
All right, we will see how this all plays out. Megan Horniman, thanks so much for joining us here this morning.
Thank you.
Let's send it over now to Catalyst co-host Madison Mills. She's here with a look at one risk asset that's underperforming. Maddie.
Thanks, Shauna. So I want to take a look at Bitcoin here, and I'm just going to pull up the intraday chart behind me. You can see Bitcoin under pressure here, down over 3.5% on the day. And this comes after the escalation of those tensions in the Middle East. Now, it's interesting, through the month of September, we typically see Bitcoin being under pressure along with the broader market, that seasonally spooky month of September. But Bitcoin actually bucked that trend throughout the month. I'll pull it over to the 1 month chart here. You can see it was ending up over 2.5%, but over the last 5 days, you can see Bitcoin under pressure, down 8% here. And it's interesting, given that we're also seeing the risk-off sentiment playing out, not just in Bitcoin proper, but also in some of those Bitcoin stocks. Think MicroStrategy, Coinbase, also under pressure here. You can see Coinbase down over 1.5% on the day, MicroStrategy down over 1.5% as well. And then you've got Marathon Digital, the miners, also experiencing a little bit of pressure. Now, it's not just the geopolitical tensions spelling bad news for crypto and the crypto space more broadly. It's also some other global factors happening right now. Think central banks around the world cutting back on interest rates. That was kicked off, of course, by the Federal Reserve cutting. Is that going to lead to a broader rate cutting cycle, which again could lead to a risk-off sentiment? We also, of course, have those geopolitical tensions ongoing and that November election here in the United States, all adding to question marks about how volatile Bitcoin is going to be over the next month. Having said that, if you take a look at Bitcoin over the last 5 years here, obviously an incredible run, up over 622%. But in the month of October every year, Bitcoin rallies, and crypto enthusiasts call it Uptober for Bitcoin. So the big question, are we going to be able to see those gains again, or will all those global factors that I just pointed to continue to put some pressure on Bitcoin moving forward here, Shauna?
All right, Maddie, thanks so much for breaking that down for us. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. Again, 13 minutes into the trading day, taking a look at how the major averages are shaping up. You're looking at downward pressure still across the board. You've got the Dow off just over 130, the S&P off about 0.6%, and the Nasdaq leading the way to the downside. Worst performer so far of the session, although only 13 minutes in. We'll be right back. Much more on Morning Brief. Tesla shares under pressure here this morning, off nearly 5% after deliveries came in just below the street's estimates, according to Bloomberg. But despite the slight miss, sales were up more than 6% during the quarter, marking the company's first quarter of growth this year. We want to bring in Jed Dorsheimer. He's an analyst covering Tesla with William Blair. And Jed, it's great to have you here. So we're seeing this market reaction with the stock off nearly 5%. When you take a look at the numbers, especially factor in the fact that this is Tesla's first quarter of growth here for deliveries, is this a bit of an overreaction to the downside, or how are you looking at this?
Well, I mean, the setup going into the 1010 event, which is on the robotaxi, is you've seen a number of other banks that have taken up expectations on delivery. So you've seen a creep up, this quarter, which is coincident with the stock rise. And so, not surprising to see a pullback as you have a bit of a disappointment here. Our focus is largely on the energy side, which they came in about a gigawatt hour under our expectations as well. I think Tesla is better looked at through the lens of the patience stabilized. So, we're not seeing the reductions, as you pointed out, that we saw, earlier in the year. And there are some key catalysts that are coming up. One is robotaxi. Two, the one that we're really focused on is on the energy business, getting Shanghai built where they can double the capacity and really start delivering more of these mega packs.
How far out are you modeling for robotaxi to be a real contributor for Tesla's bottom line?
We're not. So, that is a point that we're different from others. There's others that are much more bullish. We're not there yet. So, if you kind of go back, my history with Tesla was being able to call the, Model S and X go into the 3 and Y in that Shanghai kind of acceleration circa 2019 timeframe. We see a similar setup with respect to energy. And that's why we're focused on this. One, there's a lot of demand in the market for this product. They're supply constrained right now, and it is lumpy. But as they get this manufacturing facility up, that's kind of what our focus is.
And so with that in mind, as you look across the regions where Tesla has made really specific and profound inroads to make sure that they can appease local governments, whether that be in the Gigafactory in China and in Shanghai, and then additionally in Europe, where they're anticipating to ramp up production there even more so. What is the territory that they need to get right, especially given the consumer backdrop that they're navigating for purchases of these luxury electric vehicles?
Well, I don't think I think the whole, on a vehicle side, it's not about luxury anymore. It's really about getting to high volume and lower price. And so I think that was the Model 2. The market clearly wants the Model 2 in a lower price, and we've seen some push outs around that. And I think we'll get some updates around robotaxi. What I was talking about is actually in the energy side and kind of ramping the manufacturing capacity. Our grids are stressed to the max right now, and that's a global statement. And so, looking at Megapack as a solution for a portion of that demand, in our opinion, could be as much as what we're seeing on the vehicle side. And so, really, it's about time to market. And that tends to be, as you point out, the geographic location of where your manufacturing facility and your time to market is always going to be sooner over in Asia. And so, that's our focus. And we think that could add $2.35 of additional incremental earnings in our 27. And so, I think that is an area that a lot of people aren't focusing on.
That is so interesting, especially when you talk about the fact that once they do get Shanghai built, they're going to be able to double that capacity, really start delivering more on those mega packs. I guess just in terms of even longer, if you're looking out beyond 2027, you're talking about this massive opportunity here within Tesla. What does that upside look like 5-10 years from now?
Our model doesn't go out, so I'm going to refrain from commenting on, but I think obviously in our analysis, what we found is that the variabilities from renewables are actually creating a lot of the stress within the grid, and that the mega packs were not being used just to augment the time duration on solar and wind, but actually to stabilize the grid, which means that the TAM, or the market opportunity, is actually far larger. because if you think about taking coal down, or maybe replacing that with some natural gas or nuclear for baseload, having that stabilization to offset the 10+% penetration of variability from wind and solar, that's a much larger market. And so I think the return on invested capital on the energy business could actually be greater than that on the auto business.
Jed Dorsheimer, who is the William Blair Group Head of Energy and Sustainability Research Sector. Thanks so much for taking the time here with us this morning.
No problem. Pleasure to be here. Thank you.
Thank you. Guys, coming up, check in on China stocks as they spike. We'll track down some of those moves on the other side of the break. We're taking a closer look at Yahoo Finance's trending tickers, and some of the biggest moves taking place this morning are in China stocks. Taking a look at the green across your screen, take a look at Alibaba, JD.com, PDD, Baidu, Li Auto, as the Full House theme song would say, it's everywhere you look, all moving higher as investor sentiment improves towards Chinese tech stocks, thanks to a series of fiscal and monetary policy initiatives aimed at reviving its economy here. So there we're taking a look at these moves higher here, and most notably, one of the things that this draws back to is what UBS is saying. They're even more optimistic than they were at the start of last week, thanks to some of that better policy coordination and resolve, and looking for even more low single-digit percentage further upside for Chinese equities.
Yeah, I think when you take a look, almost at the mixed reaction, I would call it, because as some analysts, some shops are very bullish about the opportunity in China, given that stimulus, the fact that we did see the $500 billion in Chinese stimulus here. But again, I think it's still very much a prove me, a show me story at this point, right? I think there's lots of questions about how far this will really be able to carry China's economy and whether or not it's going to be enough here to really improve that economic backdrop and exactly what that means here for future growth. But when you take a look at the names that we just had on your screen, and even taking a step back and taking a look at China stocks overall, you've got China's benchmark CSI 300 entering a new bull market this week. You've got China stocks coming off the best month that we've seen since 2022. And then in Hong Kong, you got the Hang Seng Index. That's still moving to the upside here, adding 27% here over the past month. So again, we have certainly seen this risk-on rally, it seems like in China right now, at least over the last week or so. But I think there are some red flags just in terms of maybe how far the sentiment can carry, how far this can really go, given the fact that there are a lot of questions about whether or not the stimulus is actually enough to really change the investment thesis in China right now.
Yeah, it really can't be understated how large of a move these are. In the latest stimulus and stimulative policy steps even. Late Sunday, they also said that they would reduce mortgage rates for existing home loans before the 31st of October. So that in itself is driving immediacy. That is what they're trying to do in terms of really making sure that this shows up. And in this policy coordination, it's a larger implication for banks, for some of the home builders even in the region. So it has a real estate implication. And then if you buy a new home, it could potentially even play out into some of the new products that you put into those homes. So kind of far reaching, but that was a major step. And that kind of took me by surprise. That also came up in UBS's note as well.
All right, we'll keep it right here on Yahoo Finance. Coming up, we will turn back to the geopolitical risks weighing on the broader markets here this morning. That's coming up next on Catalyst. Stay with us. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day. Let's take a look at three market catalysts that we're watching here this morning. Geopolitical tensions pressuring stocks but lifting commodities, and Tesla deliveries getting a boost from China.
And a risk-off sentiment hitting the market amid those increased geopolitical tensions. What market technicals might be signaling to traders about what's coming next? We'll discuss.
Plus, oil continuing to climb following concerns of further escalation in the Middle East. Meantime, wary investors taking a pause after pouring money into gold. We'll get you prepared for any further disruptions in the sector.
And Tesla's third quarter deliveries falling just short of the street's expectations by about 1,000 vehicles. And that comes despite a lift in China due to government incentives for those purchases of EVs. Now attention turning to the EV maker's robo-taxi event next week. That'll be the next big catalyst for the stock.
Let's kick it off with oil prices. That's capturing our attention here this morning. Once again, moving to the upside amid fears of supply disruption as tensions escalate in the Middle East. We saw a 5% climb. Yesterday, you're looking at another 3% climb in crude here, 3.5% climb in crude this morning. We want to bring in Bill Baruch. He's founder and president of Blue Line Futures. And Bill, it's great to have you. So here we have crude just above 72 bucks a barrel. We certainly have been in this upward trend over the last couple of days as we have been getting some headlines out of the Middle East. I guess my question to you is what does that upside trajectory then look like? Are we going to continue on this trend higher?
You know, I think it's been a good bottoming pattern. There's been definitely some flushes. And really when the market has traded lower at the lower end of its range, you want to see that sentiment shift very negative. And that's exactly what we've seen. We've seen almost record bearish positioning in the market. And if everybody's sold, who's left to sell? So if we do start to rally, there is fuel to take this thing higher. And I mean, look at the 200-day moving average. I think around $75 is really a point to look at. We have some significant resistance. We put out research every day for our trading clients. About 73.25 is a big level that we have to clear. But outside of those two, I mean, I would imagine if the fundamentals continue to stay favorable, meaning Saudi Arabia does not try to take market share, which is the outlier right now. But if that doesn't happen, I think $80 could be in the cards before the end of the year.
But we know, Bill, that Saudi Arabia is trying to take market share, and that's just one of the many challenging parts of this sector. You've also got oversupply, lack of demand from China, plenty of geopolitical issues to pick from. Given that, how much room does this rally have left to go?
Well, the OPEC, the JMMC, is meeting right now. Now, this is the oil ministers of the top producers. And really what they want to make sure is that some of these countries that are part of OPEC are not overproducing. And so really the messaging that we're seeing very early on in this meeting, which just started a little bit ago, is somewhat favorable and supportive to crude prices for now. So I think that is something we've got to keep a close eye on as the week unfolds. But if we don't hear much about Saudi Arabia really trying to gain that market share, then I do think that's coming out of this meeting could actually in and of itself be favorable too.
You know, Bill, I'm curious, just when we talk about drivers here to the upside, you obviously have the unrest in the Middle East. You've got Saudi Arabia's play here. And then also just on the back of the stimulus out of China last week, I guess, how much does that change the supply demand, I get more so the demand dynamics of the equation, then maybe further support that move to the upside?
Well, let's talk about a couple of things that you mentioned here, and then really get into the Middle East tensions first. Second, so first, the China stimulus is supportive. I mean, China was exporting deflation. So I think that's something that for a long time that was a headwind to the oil market. So their supportive narrative stimulus is going to help drive crude oil. Now, when Saudi Arabia, if they're going to bring production back online and try and take market share, that certainly offsets it. Got to remember the U.S. is also at record production as well. But when you look at that, though, inventories are really at the lower end of where we've seen things seasonally. So that's supportive to the market. Now, you do trickle in this Middle East tensions that's been going on and has escalated now more recently. The question is, does Israel now retaliate and respond to yesterday's attacks? Then what does Iran do from there? Do they put a squeeze into the Strait of Hormuz? Do we see different pipeline disruptions? Those are the questions that as we go into, say, a weekend, if this continues to escalate, could be a big tailwind to prices in the near term. So there's a lot of factors playing into this market right now.
Bill, talk to us a little bit more about what you just said there, the potential blockage of the Straits of Hormuz, because I was reading about that this morning, handling almost 30% of the global oil traffic. How are you modeling that into your forecast here and just the uncertainty surrounding that event?
Listen, I mean, I think if that actually happens and there's a stranglehold there and there's a serious blockage or serious delays, I mean, we should clear $80. That's going to push crude oil prices significantly higher. That is a game changer. So keep that in mind. Now, with that said, I mean, I did point to record U.S. production. The potential Saudi Arabia comes out of this meeting and does have a bearish impact on prices. So the way that we're positioning is really managing our risk. crude oil volatility coming into the week before yesterday was very, very low, meaning options prices were very cheap. So we've been trading this market using options. One of the positions that we've been positioned here with, outside of some other trading, the core position is we're looking at January $75, $80 call spreads, and our commodity trading advisor, it's a CTA, sort of like a commodity fund. That is, they were a little over about $1.25 a piece on a $5 wide spread. I think those have some good tailwind in managing our risk.
So, Bill, bring this back home for me to not just investors, but individuals who are impacted by prices at the pump. In the next 6 months, what do you think that gas prices are going to look like based on the context of all that we've talked about?
You know, gas prices have significantly lagged, you know, this move here in crude oil, just from I mean, looking at some of the gains here today. You know, I think it's really tough to say. I mean, I think there's a number of forces. I don't want to go on a limb here and say that we're going to see significantly higher gas. Because there's a number of forces here, and we're going into a presidential election. So I don't want to go out on a limb. Really, what we're seeing here, and I would rather put the focus on, is the significant bearish sentiment, meaning there is significant upside here. I think we could see, if something in the Strait of Hormuz was blocked, we could see a 20% rise in crude oil pretty quickly. I think that would correlate. Maybe at some point gasoline could outpace crude oil. But again, I think we're heading into a presidential election here in the United States, and that does center domestically. What do we see in the reaction of prices? So there are, again, a number of factors here, and that's why I'm leaning more into options and helping manage our risk amid this volatility.
All right, Bill Baruch, thank you so much for joining us. Bill is the founder and president of Blue Line Futures. Israeli Prime Minister Benjamin Netanyahu vowing retaliation for Iran's attack against Israel, saying, quote, "Whoever attacks us, we will attack them." Iran's strike is the latest in a series of escalating moves in the region, threatening a wider conflict in the Middle East. For more, we're joined by Steve Clemons, founding editor of The Washington Note. Steve, it's great to have you on with us here. I want to discuss your take on the influence that the United States might have in this conflict. I know you've discussed this a lot with your own sources here. To what degree do you think the United States has any control about what might happen with these tensions?
Well, look, first I should say the United States is firmly supportive of Israel's right to defend itself. It was informed by Israel of the attack on Hassan Nasrallah, the head of Hezbollah, before it went forward. And there's a very, very tight relationship. And of course, the United States is supplying much of the weaponry that Israel is using in these exercises, in these efforts to basically rid itself of some of these challenges. That said, we've seen now for nearly a year, really since October 7th, that Israel and its prime minister and its leadership right now, Benjamin Netanyahu, have largely, they played along with the United States and White House pressure to be cautious, to not widen the conflict. And really, what you see is Prime Minister Netanyahu has a plan. He's very focused. He's using the instability of this moment to go after some of Israel's deepest and biggest enemies. And he is not really listening to President Biden. So when you ask the question of how much influence the White House has, it has potential influence of cutting off weapons support, but it's not going to do that. And right now we see Prime Minister Netanyahu pretty much ignoring Joe Biden. And so the only option the White House has to do is to really line up with Israel, show its support, and see, watch how Israel plays out this next set of steps.
Steve, what are the ramifications for the global economy? And I guess when you're putting this type of event into context, are we almost starting to enter or at risk of entering uncharted waters?
Well, we are in uncharted waters, but let's be clear. Both of these adversaries know each other really, really well. And we've seen, not just in this past year, but over many years, calculated hits back and forth between the IDF and Israel forces and terrorist operations, Hezbollah, Hamas, and beyond that, Iran's other proxies in the IRGC. We've seen recently the assassination of Ismail Haniyeh, the political head of Hamas. Of course, we had Nasrallah killed. And Israel has shown a very, very robust capacity to take down its rivals. And of course, we've seen an incredible incursion, really the demolition, if you will, of Gaza. So I think in this space, we're already in uncharted territory because you're seeing huge swaths of land being destroyed. You're seeing incursions across borders. Israel has not gone into Lebanon since 2006. And while Iran has hit and has sent 180 ballistic missiles, there were no casualties that we know of. There were no, I mean, they were intercepted. It really shows the prowess of Israeli technology and U.S. technological support. But I think in this, what's really important to remember is both sides are posturing as well to show their audiences, to show their citizens that they're not going to take it from the other side. And we're in a tit-for-tat escalation right now. Iran has communicated that its attack is over, that it doesn't want to do anymore. And Israel is saying that's not good enough. We're going to make you pay for what you did, Iran. And so there are a lot of people that now expect, because of that posturing from Israel, it's hard to back up from that, and Israel will strike in some way. So when you ask what impact could this have on the global economy, well, Iran is a major oil producer, and anything that raises anxiety about the flow of oil in that region could contribute significantly to concerns about shipping.
Well, given the prowess that you mentioned Israel has here and the potential impact on the global economy, how likely do you think it is that Israel would take care to not escalate in any way that could impact energy specifically, to not strike any areas that could significantly impact commodities?
So I don't know what Israel is going to do. Maybe, the prime minister says, we've shown our prowess, so maybe they run planes over Iran, maybe they bomb nuclear facilities that Iran has in development and trying to destroy the centrifuge creation. But my sense is that any of that, it's not just what Israel will do not to impact Iran's oil and gas capacity. It's the question of what does Iran then do at that moment? Does it basically target ships in the Persian Gulf? Does it identify allies and fellow travelers with Israel in this conflict? Because it's not just this next strike, particularly if it hits at the heart of Iran's nuclear capacity, because that will go to, a crown jewel of the realm, so to speak. And then the question is, Iran is in the same situation as Israel is now, trying to demonstrate resolve and capacity. And believe me, it's a lot easier to hit ships in the Persian Gulf than it is to hit Tel Aviv, apparently.
All right. Well, Steve Clements, always great to have your insight here. Thanks so much for joining us on Yahoo Finance this morning, founding editor of the Washington Note. Thank you. Coming up, we're taking a look at some of today's trending tickers on Yahoo Finance, giving you the news behind the moves. That's coming up next on Catalysts. Now time for some of today's trending tickers. Scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First, we're taking a look at defense stocks here this morning. Lockheed Martin, Northrop Grumman, and RTX all moving to the all pulling back here this morning after getting a boost from Iran launching missiles at Israel yesterday. When you take a look at the market reaction here this morning, we are seeing a bit of a pullback here after yesterday's jump, not fully erasing the move to the upside that we did see yesterday. Of course, we did see this move, this flight into some of these defense stocks on the heels of escalating tensions between Iran and Israel and what exactly that could portend just in terms of escalated fighting over the next potentially several weeks. So this morning, we are seeing a bit of a give back there on some of those names. Again, not too much to make since it doesn't necessarily reverse yesterday's move. But again, we are seeing kind of a bit of a reversal, I think, from the initial flight to safety, and you can make that argument almost across the board here, Maddie.
Absolutely. It's interesting given the degree of upside movement we saw, particularly in the aerospace and defense sector yesterday. As you mentioned, that sector of stocks up nearly 2%, and you can see on your screen now a bit of that run up earlier in this week off of the heels of those escalating tensions. But some analysts are saying, and you can already see this in the stock prices today, this isn't the safest way to play a situation that has yet to fully unfold and that we still have a lot of unknowns about. They're saying it's actually potentially a better place to be defensive in utilities because you have exposure not only to these defense names, but also to some of that AI rally that we've been talking about and some of the growth that we're seeing in data centers. Obviously, utilities, one of the biggest gaining sectors of the year so far. So not too surprising, but interesting to hear that on the heels of this news.
Yeah, it's very interesting. And you've got utilities rising to another record high this week. We talk about the fact that it's particularly interesting given the fact that we have seen this continued move higher on the back of a rather large cut from the Fed, which doesn't necessarily portend to what we have seen historically. So again, when you see the fact that so many of these analysts, so many strategists are coming out saying that there's still money to be made in utilities, and maybe it makes more sense here, especially than going in and buying some of these individual names, that certainly remains to be a sector to watch here.
Absolutely, and something we will keep covering, I'm sure, as well. Let's talk about Tesla, though. Those third quarter deliveries out this morning, hitting 462,890 vehicles, just short of expectations of nearly 464,000 deliveries. We spoke with William Blair, Group Head of Energy and Sustainability Research Sector, earlier in the hour. Let's take a listen.
There are some key catalysts that are coming up. One is robotaxi. Two, the one that we're really focused on is on the energy business, getting Shanghai built where they can double the capacity and really start delivering more of these mega packs.
You just heard there from Jed Dorsheimer over at William Blair. And it's interesting given that there was a lot of optimism about what these deliveries were going to be because of increased incentives from the Chinese government to purchase EVs. But even though we did see a lift in that region, it just wasn't enough to beat the kind of whisper numbers, as Dan Ives was calling them, about what these deliveries were going to be here. But overall, it is a clear improvement. And that's something that Evercore was talking about, that it was definitely improvement from the first half of the year. So not too terrible, but not enough.
It wasn't too terrible. That was almost the point that Jed was making as well, right? You have so much factored in. You have a lot priced in ahead of these upcoming catalysts. He was focused a lot about the energy side of the story, but he also did mention robotaxi very briefly, talking about the fact that it has captured the street's attention ahead of the event that we're going to be getting in next week on October 10th. What really stuck out to me, though, within Jed's commentaries wasn't necessarily what he was saying about robotaxi, but more about the opportunity within energy. And Maddie, I know this is a subject that you've been following very closely, but just in terms of specifically what this could mean for Tesla and the fundamentals and the earnings picture there, Jed went on to say that he actually thinks they could add about $235 of additional incremental earnings there looking out to the modeling in 2027. So again, when you talk about the fact that there is potentially a lot of upside, a lot of room to run here for Tesla stock, many analysts focus specifically on robotaxi. Yes, that will likely be huge here and will be a catalyst potentially for the stock next week. It's also important to keep in mind that energy play, the energy side of the business, specifically what's going on with the Shanghai plant and how that could then potentially further boost stock prices to the upside.
Absolutely.
If these analysts are correct.
Right.
All right, finally, taking a look at Humana disclosing a lower performance rating for its largest Medicare Advantage plan. That could hit revenue in 2026. And you're looking at a massive move to the downside here for Humana, looking at losses of just about 16%. We also saw the drop yesterday here. But again, lots of questions about what ultimately, how big of an impact or how big of a challenge this is going to be for Humana. When you take a look at the degree of the drop that we are seeing, shares falling 22% at the open here. So we are just off the lows of the session. That had been the biggest intraday drop that we had seen since 2009. So you can see the street really taking issue with this, trying to figure out what exactly this means just in terms of the impact that it could have on revenue down the line. This drop in the Medicare Advantage quality ratings really posing potentially a huge threat to some of their revenue here going forward.
Yeah, and just for some context on these star ratings, this is something that individual consumers really look at to suss out which plan they want to go with here, right? It's something that looks at, for example, the reviews of prescription drug pricing, something that helps consumers suss out how much they're going to have to be paying for their healthcare in the year to come. When your star rating goes down, that could be a sign for consumers, hey, maybe I should look elsewhere. And that's why we are seeing such a big drop in these shares, down 24% after the news first dropped. We're already getting in some analyst commentary too that I want to point to. JP Morgan saying the star decline has significant implications for Humana's payments from Medicare moving forward, and that this could be disproportionately felt at Humana versus other companies here, and that the 2027 margin risks here could undoubtedly be worse than expectations. So something that not only could impact the stock today, but could impact the stock for years to come.
Yeah, Maddie, that's such a good point. There's actually some data that was compiled by a health researcher, KFF, and they've just put into context how high of a stakes this is here in terms of their calculation for insurers. Drove an estimated $11.8 billion in bonus payments to insurers this year. That included $2.5 billion to Humana. So again, when you take into account just the fact that we did see a lower rating here, just what exactly that could mean here, known as stars, what exactly that could mean for the future demand and the risk that that then poses, that explains the degree of the drop that we're seeing in shares here today.
Absolutely. A story we will continue to cover there as well. But coming up, we're going to take a look at the market technicals and what they spell out for the trajectory of stocks, which you can see down across the board of the major averages right now. We'll have that and more next on Catalysts.
Stocks wavering today, but honing in on big tech. What are technical indicators saying about where Tesla and Meta are heading? Data from Oppenheimer showing that Meta is poised to outperform and honing in on Tesla despite today's pullback. Technical indicator showing that it's trying to make a bullish reversal. Here to break it all down, we want to bring in Ari Wald. He's the head of technical analysis at Oppenheimer. We just had the Meta chart up on the board. We also have a Tesla chart that you sent over in your most recent note. But Ari, just taking a step back, because this is really at the crux of your note that you sent over, that you were distinguishing between buying growth or buying beta to gain exposure to the market upside that you see. So walk us through your thesis and where you are seeing that opportunity.
Sure, and I'll even take a step back from there. How we just to lay it all out is just thinking for the market as a whole. I think the key positive here is that market breadth remains firm. It argues against a major top and instead supports higher highs looking out into year end. We have a new high in the NYSE advanced decline line. We got the equal weighted S&P 500 coming off new cycle highs, and the percentage of NYSE stocks above their 200-day average coming off a level of 66%. We said, I think as long as that reading's above 60%, it's a healthy reading. So for all these reasons, we do think that the bull cycle is intact and it's positioned to move higher into 2025. As far as exposure, there was some changes in the leadership backdrop during that late summer move. That we had a change in the high beta versus low volatility ratio. We had interest rates break lower, and some of the high beta stocks were not able to keep up with some of the higher dividend paying, lower volatility names. And so for market upside, we'd love to see beta come back. I think it would be important for the cycle if it can reclaim that leadership role. But really, the more compelling idea here for us is buying these higher growth companies. I think the scarcity premium comes back against a lower growth backdrop for these names. Thinking about the Nasdaq 100 as a proxy for that, or just the Russell 1000 growth. It has underperformed since the summer, but I think through this rotational nature, it is set up to lead again. It did a good job holding up support levels. And so for that reason, it's for us, it's growth for the long term. I think this is a growth and tech-led secular bull. And then on a near-term basis, it's become tactically attractive to buy that style as well.
So talk to me then just a little bit more about the Tesla of it all, because as of this morning, they had some news about deliveries coming in a little bit underwhelming. Obviously, the robo-taxi event is the next potential big catalyst that investors are looking for. But since you're a technicals guy, do the kind of technicals that you see on the charts that I know you look at all the time, Ari, indicate a growth story for Tesla that those fundamental pieces of company news just might not be capturing right now?
Well, it's one of the Mag 7 stocks that has had a difficult time in recent years. It's technically been making a series of lower highs, but it's starting to make some higher lows as well. So it's been in this narrowing range, but we're starting to see some signs. And I guess we're siding with the fact that you have some top-down strength just based on the support from these higher, large cap growth companies, that this reversal should ultimately resolve to the upside. There's more that's needed. It's more of a rotation idea, but there are some signs that the trends are showing incremental improvement and could continue to grind higher. I think really the standout idea, the leadership name, would be Meta Platforms, a name that had been in a consolidation range, and through that summer volatility showed terrific resilience and relative strength. And now as market conditions firmed, is breaking out to the upside. So for us, it's Meta for leadership. I think that's perhaps the most constructive and bullish Mag 7 chart. And then for rotation, looking at a stock like Tesla, which is not yet at new all-time highs, but over the coming months to perhaps quarters, maybe got to give that one a little bit more time, it could ultimately get there again.
Sorry, we're really zeroing in on these two tech names. I'm curious, though, the seasonal tailwinds, are they at play here, and what are you watching?
We're getting close. I also kind of looking at the other way. We want to be mindful for the fact that October hasn't been a particularly strong month in an election year. Now, if my one concern is seasonals, I really don't have much to be concerned about. I think price action does take precedence over seasonal tendencies. But when we align the two, we can make, I guess we are encouraged that we are getting to that point where tailwinds do come back in that November and December period, especially as you approach that U.S. presidential election. Markets do typically strengthen afterwards and sets the stage for another year-end rally. So I think in conjunction with the strong price action, we want to be reasonable in our expectations for October ahead of what should be seasonal strength in November and December.
Seasonal strength that could also be impacted by some of those unknowns like the outcome of that November election. But I'm curious to get your take on how that could impact a little bit of that rotation trade that we've been talking about, specifically within small caps. What are you seeing there about what investors should know about how much room there is left to run outside of those major averages and inside an index like the Russell 2000?
It really becomes a discussion between absolute participation and relative leadership. In absolute price terms, the Russell 2000, finally started to get going this year in 2024. It broke out of this multi-year bottoming pattern. Every time it looks like it's trying to accelerate higher, it gets hit by this market volatility and comes back in. Now, it's upheld support levels, and the trend is still higher. And I think based on our overall market views, and the saying goes, a rising tide lifts all boats, I think the Russell is positioned to push to the upside as well into year end and into 2025 as well. On a relative basis, it is a different story. Looking at the ratio versus the S&P 500, we still favor large caps. We think that the large caps are the more attractive risk reward area of the market. We like relative strength. We like long-term momentum. And for us, large caps are going to continue to rate higher for us. And it becomes even more compelling as we push later cycle, which is a period that typically you'll see relative strength go to those larger capitalization names.
All right, Ari, well, thank you so much for joining us. Really appreciate it. Ari is the head of technical analysis over at Oppenheimer. Coming up, semiconductors falling from their highs after the Micron-driven rally. We're going to talk about what's next for that sector, plus a programming note. Join us as markets editor Jared Blickery sits down with A-list strategists to decode the day's market moves. From word of the day to who wore it better, this is Yahoo Finance in its best form. Stocks in Translation airing every Tuesday and Thursday at 8:30 a.m. Eastern Time. You don't want to miss it. NVIDIA shedding $110 billion in its market cap on Tuesday amid that broader market sell-off, and the pressure on NVIDIA since its earnings has left room here for another company to get in here as the leading gainer on the S&P 500. You might have not heard of it. It's Vistra Energy. We're going to take a look at these two stocks over the last month here. This is NVIDIA. I know it's shocking to believe that NVIDIA is the laggard here, but really trailing in comparison with Vistra Energy, up 43% in the last month. NVIDIA there up just 2% rather. This is since early September. And it's interesting because of the degree of gains that we are used to with NVIDIA, but Vistra outpacing those gains. And just to give you a little bit of background on Vistra Energy and why they're experiencing such a rally right now, let's introduce you to this company. So this is a power generation company. It's a clean energy play. They recently purchased 4 nuclear plants, really getting in on nuclear energy as the demand for energy is increasing so much amid that AI rally. That is leading to a lot of concerns about how we're going to have enough energy to meet the demands of artificial intelligence. Every time you're utilizing ChatGPT, that's requiring a lot of energy. That's where a company like Vistra can come in, and their competitive advantage is that clean energy approach. Also really important here, they're operating in unregulated power markets, so they have the ability to put in a little bit of pricing power that other utility players in the space just don't have. So that is another thing that stands out about Vistra Energy, and part of the reason that we are seeing this degree of a rally for Vistra over the course of the last month here. Again, Vistra becoming the highest gainer in the S&P 500, taking NVIDIA's place with it. And by the way, it's not just Vistra, a leader in this space. We're also seeing Constellation Energy on the heels of their deal with Microsoft to restart that nuclear plant at 3 Mile Island, of course, pending regulatory approval. But guys, this is just a story that is going to continue to have legs as we hear from more of these operations from these clean energy firms and these utility companies that are working to get in on the clean energy space and nuclear energy in particular amid that broader AI boom that's leading to a lot of needs for energy moving forward here, Shauna.
All right, Maddie, great chart to point out, especially since Vistra might go under the radar for so many investors out there, given the fact that it's not nearly as well known as some of those other names that you mentioned, especially NVIDIA. Let's stick with the semiconductor industry after the stocks did lead the sell-off that we saw on Tuesday. As Maddie mentioned, NVIDIA losing nearly $110 billion in market cap. What's the outlook for the broader sector? Here to discuss, we want to bring in Christopher Danley. He is Citi's head of U.S. semiconductor research. Chris, it's great to have you here back on Yahoo Finance with us. I guess give us a sense of what your outlook is right now for the chip landscape, because we did certainly see a lot of optimism following Micron's report. We saw shares move exponentially higher, and yet here we are just about a week later, and we're in this downward trend. So what does that signal to us?
Yeah, I mean, semis have always been quite a volatile space. I think it's still one of the best sectors on the year in terms of performance. And what happened in the last couple of days was you had this big slew of automotive data points that were very negative. Same thing happened last quarter. A bunch of the automotive OEMs, BMW, Volkswagen, and some of the supply chain talked about lower sales. We had that last quarter as well. And so we think that there is some more weakness coming from the automotive space in semis. It's like 10 to 15% of the semiconductor sector, so not an insignificant part. And then you contrast that with the AI realm. Micron, one of the leading AI companies, reported last week, lots of upside there. Obviously, NVIDIA, AMD, they've all been reporting upside. So it's like this push-pull. AI is now about 30% of semis. So that's clearly leading the charge. And, like I said, the semis are still up, I think, 25, 30% on the year. So it's a pretty decent year. It's just, there's some volatility. There's some parts that are good and some parts that are not so good.
So given what you said about the degree of the semi space that is reliant on the broader AI story, I'm curious from your perspective how individual companies like Tesla could impact the semi space moving forward. The CEO of NVIDIA, Jensen Huang, saying on Yahoo Finance's air that he's excited about Tesla's self-driving capabilities moving forward, and therefore that kind of partnership between those two names. What does that tell you about the relationship? And I guess, can you just give our audience some context about why it is that a company like Tesla and some of those chips names might be linked in terms of performance?
Yeah, I'm glad you asked that question. So if you look at the AI space and where the bulk of the spending is coming from, it's the cloud companies. So the big four, that's Amazon, Microsoft, Google and Meta, Facebook, Meta, whatever they're calling themselves these days, they're responsible for the bulk of the spending. But then you also have other companies that are starting to spend more on AI, like Tesla. So I'd say for investors out there, number one, you really want to look at the CapEx of what the big four cloud companies are doing. It seems like their CapEx has been moving up every quarter. That's the thing that we're going to be watching most during earnings. But then you also have other companies like Tesla that are getting into the space. But really, I would say focus on the big four, and in particular, what the outlook is for next year. Now, if you look at the main AI companies, in semis, number one is NVIDIA, obviously. Number two is a company called Broadcom. Then number three is AMD. We expect AMD to raise their AI forecast again during earnings. You've had consistent upside from Broadcom, from NVIDIA. That should presage very good spending by those cloud companies.
Chris, when you take a look at some of the other top picks that you have within the sector, you have ADI, analog devices, as your top pick. You moved it to your top pick because you believe more of that lower downside risk in autos versus some of those other analog names. Walk us through that investment thesis and I guess what you think that upside opportunity looks like here for ADI.
Yeah, good question. So yeah, we just did get a little more defensive, really from a broader space on semis. Because of that volatility you talked about, there's going to be some, some companies that are going to be taking numbers down during earnings. So analog devices is known as a defensive stock. Remember, we're cautious on the automotive space and a couple of others. We've seen some cooling in the PC market and also the handset market. So these are two of the larger markets for semis. ADI is known as what you would call a defensive play. We also got a little more defensive on the semiconductor equipment space. Overall, as spending has come down in semis because of some of this weakness. ADI does have some automotive exposure, but it is lower than some of the other analog companies that we think there's going to be some weakness. ADI has always been known as a defensive stock. Also, ADI just reported they're on an off quarter. So if there is any downside out there, then you would think that that would be incorporated into their guidance. They also have some of the largest exposure to the industrial end market. You contrast industrial versus automotive. Industrial space and semis had a massive correction. On average, those revenues were down 35-40% across the board. ADI, by virtue of their large exposure to industrial, we've seen that sector recover over the last couple of quarters. We think it's going to continue to recover into next year. That should benefit analog devices. So we see that as having some of the most earnings upside in semis over the next 6 to 12 months. Obviously not as much as the AI names. We've got buys on NVIDIA and AMD and Broadcom and all your buddies there in the AI space. But we just wanted to go a little more defensive for now, and that's why we elevated analog devices.
Christopher, just want to end by getting a sense of a potential competitor in the space, Cerebras Systems filing to IPO, the first chips maker to do so. Do you think that there's any risk to market share for an NVIDIA and for a name you cover, AMD?
Well, we're on that deal, so I can't really comment on it for now. But what I would say is, in terms of the AI market, we think it's going to be $400 billion in a few years. So there is plenty of room for folks to benefit. And if you look at the top three AI names that I mentioned before, NVIDIA, Broadcom, AMD, I mean, you could even add Micron in there as far as memory goes. All of them have seen spectacular growth this year. We think they're going to grow well into the next couple of years. So there's plenty of room for folks to benefit from the AI space. If you look at the amount of CapEx, by the way, that these cloud companies are spending, it's $30, $40, $50 billion each for the cloud companies, and it's growing at anywhere from 10 to 20, 25% per year. So there's plenty of room for multiple semi companies to benefit from AI.
All right, Christopher.
I guess even the electric companies too.
I guess in the electric companies too. Thanks for tap dancing around that with me. I really appreciate it. Christopher Danley, Citi's head of U.S. Semiconductor Research.
Academy.
Well, coming up, Joby Aviation getting an additional $500 million from its current investor, Toyota. We've got the CEO in studio with us here next to discuss what's coming up for the company. That's next.
This is as close as we've seen, I think, in terms of the technology coming together to make something that you could use on a daily basis to go where you want to go and do the things that you want to do, which is kind of what a car is all about, I think. That is something that's going to be practical and available to people in the pretty near term.
That was Eric Allison, Chief Product Officer over at Joby Aviation, one of just a handful of public companies working to get electric air taxis into the skies. Joby announcing $500 million in additional funding from Toyota today, bringing Toyota's total investment in Joby to nearly $1 billion. For more, we've got Joby Aviation CEO JoeBen Bevirt here in studio with us. JoeBen, congratulations on the funding round. We're excited to talk with you about it.
Thank you so much.
So, take me into the chats with Toyota here. I mean, they're a car company, you're a plane company. They're not really into EVs just yet. Why does this make sense?
So the Toyota family has had a dream of building aircraft for daily transportation since the founding of Toyota. And that has been passed down through the generations. And so now we've had a relationship with Toyota for 7 years, where first Toyota Ventures invested in 2017, and then Toyota invested in 2019. We've expanded the partnership. We've had Toyota engineers working on site with us in California, helping to design our processes and bring the incredible quality that Toyota is known for to aviation manufacturing. And so this is just an incredibly exciting time.
Yeah, JoeBen, it's very exciting for your business. And I was reading a statement from Toyota earlier today saying that with this additional investment, we are excited to see Joby certify their aircraft and shift to commercial production. I'm curious if you can walk us through just your plans for this capital and what those timelines look like in order to get to that commercial manufacturing and production.
Yeah, so we have our pilot line in Marina, California. And with that, our target is to get to a run rate capacity of one aircraft a month by the end of the year. We've broken ground on a larger facility in Marina where we're going to be able to expand that capacity. We've got our facility in Ohio, which we're beginning to hire employees for. So we are beginning the baby steps of the early part of this journey. But with Toyota at our side, we have the capacity to take this to another level. And that's why this is such an incredible collaboration that we have with Toyota, and we are just so grateful for them leaning in for the reliability and quality with which they're able to build vehicles, and we couldn't be more thrilled.
Yeah, and when I was at the manufacturing facility, one of them in California, I was able to see that, and Eric told me that you guys kind of have an assembly line that's similar to the way that a car is assembled, and that's one of the influences that Toyota has had on the company moving forward. You can see my little flight. It was a simulation. Don't worry, anyone. I wasn't driving the thing. But speaking of who's driving these things, I do want to talk to you about what's next in terms of clearance. And one of the big questions is that the FAA has yet to release that final ruling on outlines for what pilot certification might look like moving forward. I know that you guys have a very aggressive plan for kicking things off in 2025. If you don't even have the pilot certification rules yet, how are you going to do that?
Well, so one of the fantastic things is that the FAA is actually ahead of schedule. So they committed by the end of this year to release that. And what we're hearing is that we may see that come in the very near term. So that's incredibly promising that the FAA is just delivering on their goals. So that's on the piloting side. In terms of the certification of our aircraft, we're making spectacular progress. And there's one of the things we do as a company is that we're very transparent about our progress. And every quarter we release exactly how far Joby is and exactly the progress that the FAA has made on each of the 5 stages of certification. And this last quarter, we showed that we're more than a third of the way through stage 4 on the Joby side, and the FAA is making great progress. And we're expecting that progress to continue to accelerate on both our side and the FAA side as we move into the back half of this year.
But I'm curious what you expect demand to look like. And I think a lot of that depends on pricing and how affordable this is going to be. I know you said in the past that you want to make it, or you plan to make it affordable. I guess what is affordable? And how do you do it when you would think, at least I would guess, a lot of the input costs are very high in this types of business?
The amazing thing about this aircraft is because it flies so much faster than you can move on the ground, you're not constrained by the constraints of ground transportation. The aircraft can be far more productive. That is, that it can move more people, more miles per hour. And so that makes the operating economics very compelling. And what that delivers is the ability for us to launch at a price comparable to Uber Black and drive that price over time down to something that's comparable to UberX, which we believe makes it broadly accessible. And that's why this is so exciting. And you see companies like Toyota very leaning in and viewing this as a really important next phase of mobility.
But those input costs, to Shauna's point, you've got to electrify vertiports, you've got to get the batteries. I mean, you've got the labor of the pilot. I could go on and on and on. I'm curious from your perspective then, how much you're looking at automation as a potential way to get those costs down, and when you'll be more open about pursuing automation. I know you've historically said that's not in the cards for you right now, but that is a huge potential cost saver for the company.
So we've been working on increasing levels of automation for many years. We recently acquired one of the leaders in the autonomous aircraft space called X-Wing. They've been doing spectacular work, and it's fantastic to bring that team in. But we are launching our service as a piloted service. We think this is best for consumers and the best way to fit into the existing aviation ecosystem. And as we look to bring our aircraft to cities like New York and LA, last week we had our aircraft in LA, and the reception from consumers, the excitement is just so visceral. This week we have it at Grand Central Station, and we'd love everybody to come by and check it out. It's a really beautiful location, and we love being here in New York. We had the aircraft out here when we went public. We had it out here again this last fall, and we were able to do flights from the Wall Street heliport, and people getting to see and hear the incredible characteristic of this aircraft, and to have the city's commitment, the Port Authority's commitment to be electrifying the vertiports here. We have a spectacular partnership with Delta, and we're really excited to be bringing our vertiports to LaGuardia and JFK.
We look forward to covering the story, especially when you do get approval. Congratulations on this latest round of investment. We appreciate you taking the time, Jevin.
Thank you.
Go ahead.
Coming up, we've got Wealth dedicated to all your personal finance needs. Shauna and I will both tease this incredible show because Brad Smith, he's going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, private sector jobs rebounded from a 5-month slowdown in September. We'll break down the data with ADP's chief economist and get some insight into 5 hottest labor markets in the U.S. here. And around 3/4 of student loan borrowers had to adjust their budgets to make payments. We're going to bring you the repayment tips and tricks. Plus, the 30-year fixed mortgage rate. It's at its lowest level in 2 years. So is now the time to buy? We'll discuss the best season of the year to buy a house. All that and much more on today's show. But first, we take a look at some of today's market action here. 90 minutes into the trading day here, and stocks are near the flat line this morning. An upbeat read on the labor market, not having too much of an effect on sentiment this morning ahead of Friday's all-important employment situation, that jobs report. It's been a relatively bumpy start for stocks in September. Low sample size, but it's growing. For more on how to allocate your money and price in future volatility, I'm joined by Ben Guttridge, who is the Invesco portfolio manager here. Ben, great to have you here with us today. All right, so we're early in September. However, we have seen some volatility spike here, really on the back of yesterday's activity, especially with the geopolitical tensions in play here. So what type of anticipated volatility should investors expect to continue to play out at this juncture, at least?
Well, a great pleasure to be with you. Look, I think investors should always brace themselves for volatility. You know, that's sort of the price of entry into equity markets. But I don't think we want to lose sight of actually some pretty encouraging fundamentals. You know, lots of important things to talk about. But at the core of our view at the moment is that growth looks pretty resilient. You know, the US jobs market remains in pretty good shape. And of course, the inflationary challenges continue to abate. You know, the Federal Reserve almost sort of disinterested in inflation at the moment, and that's paving the way for some, a pretty meaningful start on interest rate cuts. So resilient growth, fading inflation, interest rate cuts. You know, yes, volatility may materialize, but that's a really healthy underpinning for stock market performance moving forward.
You know, just taking a look at XLK and thinking about the tech sector that's had this amazing run up, something that's made its way to dinner tables and the perhaps sporting lexicon, even in people who are just talking about the stock market on the sidelines. Everybody's been talking about the AI trade, and that comes back to tech here right now. But I'm taking a look at XLK, and it's had a bumpy start to October. It seems like it's catching a little bit of a bid here during today's session, fractionally higher on my last check. All these things considered, with the massive run-up that we've already seen, what are the best ways to play the tech sector right now?
Well, look, I mean, day to day, it can be pretty tricky, but I still think, you know, the sort of picks and shovels, the infrastructure to support an AI rollout, you know, will continue to be sort of the leaders within the technology sector over sort of 12 to 18 months. You know, businesses looking very closely, and certainly some of the bigger companies investing very heavily in rolling out or incorporating AI infrastructure into their business plans. So whilst I think certain market commentators quite rightly are saying, well, you know, how are they going to monetize this? I think there could actually still be some patience on that, on the basis that I still think the AI infrastructure story still can continue to play out from here. So, you know, I think some of the big mega cap tech names, you know, as I say, they're those that supply the infrastructure, supply the chips, supply the network, you know, can still be and should still be a key part of portfolios.
And when you think about the broadening that's been discussed at length, especially looking across that earnings growth that you were mentioning a moment ago here, the broadening and part of that trade is expectations of earnings growth to cascade out into other sectors outside of just the Magnificent Seven and the major players within tech that have been the beneficiaries and seen astronomical growth. So with that in mind, does the broadening hinder the tech narrative right now, or does that allow some of the investors out there to just have another position that they could consider for some of that longer term growth?
Well, look, I don't want to sort of appear too bullish on everything. I want to retain some credibility. But look, I think we're thinking about a catch-up trade here rather than sort of a catch down from the mega cap tech. So I still think within the technology sector, the AI infrastructure rollout, has room to run. But given such, incredible numbers in terms of growth, even though the market's sort of got it near enough sort of dead wrong on expectations for that growth to fade, at this juncture, you still think it's going to be very hard. We still think it's going to be very hard to maintain those growth rates. So there's sort of a big number coming down. But given the core view that a recession could be, and certainly a deep recession would be avoided, economic recovery can endure, then other parts of the other sectors within the stock market should enjoy a boost to their earnings. So a broadening out of earnings performance should allow for that catch-up trade.
Just lastly, while we have you, I was looking at a note that made its way into my inbox from UBS, and one of it, the part of the note was really talking about some of the stimulus efforts within China. We've been tracking a lot of these stocks here, at least in the early inklings of October here, and I wonder from your perspective how people should be addressing and assessing some of the stocks in the Asia-Pacific region and China specifically right now with the stimulus that's been put on the table.
Well, oh dear, it's sort of 3 for 3 that I'm positive on. So I don't know if you've got time to ask me a bearish question, but look, I think, many are quite rightly sort of calling into question as to whether this is enough collectively in terms of the policy decisions that have been taken to really reignite demand in the economy. If a consumer in China is going to be given some sort of windfall, at this moment, it looks like they might decide to pay down some debt rather than use it to spend. So, I have a lot of sympathy with the idea that the collection of policies so far may not be enough. But, as investors, I think we should recognise that policymakers have clearly sort of drawn a line in the sand here, that they've reached some sort of pain threshold that they want to manoeuvre back out of, they want to recover from. So this policy, the collection of policies, may not be enough, but there's an open-ended flavour to them, and there is a clear intent in the delivery, and there's an explicit support for stock markets as well. So, on that basis, why not? Well, it might not be this sort of dragging the ECB president, whatever it takes moment. I think investors need to be alert to the opportunity here.
All right. Well, to the extent that you're an NFL or American football fan, we'll retain and we'll hold the bearish commentary for the New York Giants. Ben Gutteridge, who is the Invesco portfolio manager. Ben, thanks so much for taking the time.
Pleasure.
Let's turn to the labor market. Job creation in the private sector in September rebounding from a 5-month slowdown. According to ADP, only one sector, information, lost jobs, while manufacturing added jobs for the first time since April. Here with more analysis, we've got ADP Chief Economist Naylor Richardson. Naylor, great to always have you on the program and grab some time. I mean, many of us here, our own Josh Schaefer, I heard him listening into the call while he was in the makeup room earlier this morning. So we are all locked into this data. Just want to get your broad read right now on the state of the labor market.
Yeah, Josh asked a really great question during that call. It really sets up the tone for what we're thinking about the labor market. We saw this rebound up 143,000 from a revised 103,000 last month. This is significant in many ways because that stronger hiring didn't need and require stronger pay growth. So even as hiring strengthened, we saw a moderation in job stayer pay and a deep decline in job changer pay, which Brad, that we track really, really closely with this huge matched individual data set at the worker level that ADP provides. So what does that mean? It means that we don't have to worry that hiring is going to lead to an increase in inflation. And so that's good news for the Fed. But it also means that the jobs market is still strong. So we're as close to a Goldilocks scenario as I think you're going to get in this labor market.
What is valued the most in this labor market, especially as you do have people that are still looking for the opportunity to change jobs or to perhaps increase their salary when they do change jobs, even though we know that based on what was in this report, you say typically workers who change jobs see faster pay growth, but their premium over job stayers actually shrank to only 1.9%, matching a low that we last saw in January. So what is really valued for those who are changing jobs right now, I imagine, from what you're seeing in the data?
Right. Well, usually you get that bump in pay when you change jobs. That's the main reason a lot of people change jobs. But what we're seeing, and this is important, that people who are staying a year or longer on the job are seeing higher pay growth, higher than we've seen before the pandemic. So yeah, you're not getting that bump like you used to from switching, but you are getting a better growth rate from staying. And I think that's that reality of today's labor market is not only translating through ADP's data, but also if you look at JOLTS, the quips rate is lower. You saw that job openings tipped up again. So that is consistent with the story that firms are hiring to grow their workforce, not to replace workers who have left, because working conditions, including pay growth, have improved over the last 3 years.
You know, I wonder, Nela, and I want to turn to some of the other research from ADP that tracks the hottest labor markets. How does the math there work, and what are some of the top markets that you're seeing right now?
Yeah, you know, we talk about the jobs market like it's one thing, one national number, but we know that job markets are very localized and they can change dramatically from city to city. So we dived into the data and we looked at 3 features of the local labor market. We looked at, first of all, pay growth. That's super important. Then we looked at new hire wages, also very important. And then the hiring rate. How aggressive are employers being in terms of adding new workers? And the winner was Denver. Denver had all of those features and then some. It was tied for the fastest growth rate in terms of pay growth in the country. But there was also other cities like Oklahoma, most aggressive hiring rate. We saw Las Vegas, that's for a sports analogy, this is your all-around player. They were good in all 3 of these features. Seattle had the highest starting rate for new hires. And then Portland brought up and rounded the top 5. So out west, we're seeing a lot of strength in that labor market. Now, we have to be cautious here. That local strength last month is going to hit the reality of the weather events that we saw recently. So we're looking at this localized increase in pay growth and in hiring rates, but we are conscious of the reality of weather events that affected key metro areas along the Gulf region and how that's going to affect next month's jobs numbers.
No, I have to hustle to my finish here, but just very briefly, does anything within this data spell out to you or signal that we're heading into a recession and that the Fed needs to cut by 50 basis points at their next meeting as well?
No. There's nothing in this data that signals recession. What we're seeing is a rebound in hiring. What we're seeing is a stability in wages. What we're seeing is still an economy that is moving forward. And so what this next rate cut would be, whether it's 50 basis points or 25 basis points, in my mind, it will help those cyclical sectors like manufacturing, who are very interest rate dependent. And if there is good news in this report, it's not just the national number, it's the rebound in manufacturing that's going to be really critical to the next few months of this jobs market.
Always very sound perspective and insights. Nela Richardson, who is the ADP chief economist. Nela, thanks so much for taking the time here.
My pleasure, thanks.
Certainly. The 2024 vice presidential nominees facing off on the debate stage last night, hitting on many of the key issues that will affect your wallet, pocketbook, purse, drawer, wherever you're putting money at. We've got team coverage breaking down some of the highlights. Joining me now is our housing reporter, Danny Romero, and Washington correspondent, Ben Werschel. Great to have you both here with us. Danny, let's start with you. The candidates, they disagreed about what's to blame for the housing crisis. Let's listen in.
You have got housing that is totally unaffordable because we brought in millions of illegal immigrants to compete with Americans for scarce homes. We have a lot of Americans that need homes. We should be kicking out illegal immigrants who are competing for those homes, and we should be building more homes for the American citizens who deserve to be here.
But we can't blame immigrants for the only reason. That's not the case that's happening in many cities. The fact of the matter is that we don't have enough naturally affordable housing, but we can make sure that the government's there to help kickstart it, create that base.
Now, Danny, you've been listening in and you've got the facts on what we just heard. What are the facts?
Brad, let's fact check these claims.
Economists tell me that immigration, including illegal immigration, has contributed to the population growing and also demand for housing, but it is not the primary driver of why we have a housing affordability crisis. This all goes back to the lack of supply and the shortage of homes, which has caused the ripple effects in the housing market. Remember, historically, the vice presidential debate really is not meant to, not designed to cause harm, really. It's actually perhaps more to reinforce what the running mate is going to do to back up the president. That's why we heard from Governor Tim Walz really lay out Harris's plan to tackle a housing affordability, Brad.
And the debate over health care also got heated last night. Here's what Republican vice presidential candidate J.D. Vance had to say.
But when Obamacare was crushing under the weight of its own regulatory burden and health care costs, Donald Trump could have destroyed the program. Instead, he worked in a bipartisan way to ensure that Americans had access to affordable care.
And so, Ben, this is becoming a top-tier issue, essentially, for the final campaign stretch here. What do you make of it?
For sure. Yeah, Danny just mentioned the fact checks on housing. This is another issue that fact checkers are really honing in on this morning. Needless to say, hearing from a Republican about efforts to preserve Obamacare is a pretty surprising one. And that tells me about the kind of shifting politics of this. And there's a lot of financial implications there. You know, Republicans spent the last 14 years trying to repeal Obamacare completely. And now we see sort of this effort to kind of blur the lines between Democrats and Republicans on Obamacare and on the popular parts of it, specifically issues like pre-existing conditions. And what that points to, I think, financially, is that there could be areas of bipartisan agreement in 2025, at least less overt efforts from Republicans, depending if they win, to repeal it, but also areas under the surface like prescription drugs and lowering the cost of those that Vance has also talked about blurring the lines on, that could come up in conversations next year amongst taxes and amongst a bunch of different issues.
Danny Romero and Ben Werschkohl, thanks so much for tuning into the debate and then breaking down some of the key stats that need to be known by voters everywhere and how this could impact the economy. Thank you both.
We watched, so you don't have to.
Look, yes, you absolutely did, even though I did tune in for a little bit. Thanks so much, Ben. Appreciate it. And Danny. Guys, coming up, 1 year after student loan repayments began, nearly 3/4 of borrowers, they have had to adjust their budgets to afford monthly payments. We've got advice for borrowers next on Wealth.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
One year ago, federal student loan payments, they resumed following a 3+ year pandemic pause. And borrowers are just now adjusting their new financial reality here. A new survey from the National Endowment for the Financial Education found that nearly 3/4 of people with student loans had to rework their budgets to make their monthly payments. Here to discuss, I'm joined by Billy Hensley, who is the CEO and president of the National Endowment for Financial Education. Great to have you here. So you heard the statistic there, and you've been looking into the numbers as well yourself. I mean, how much of a shock is this, and what type of delta is expected in terms of the payments that people were accounting for prior to this resumption and now post-resumption?
Sure, yeah. You mentioned this leading in, that last October when the repayment pause ended, we actually explored this question, what borrowers believed or expected would be the impact on their finances. And now here we are a year later, we know the reality of how borrowers are actually managing these loans. And no, this is not a small number of citizens. A little over 1/4 of the population currently have an outstanding student loan themselves or someone close to them that they love or care for, a child, a grandchild, for example. And there's some positive news and some concerning news here. The positive being that the majority of those who participated in this survey reported that they are doing okay, at least for right now. But keep in mind, nearly 1 in 5 may not have had to make payments yet. But sadly, 27% are saying the end of the pause has negatively impacted their financial lives. Now, this is lower than the 49% who were anticipating this negative impact last fall. But the true concerning news here is that monthly budgets have been strained, with 3 in 4 having to make cuts, 28% cutting up to $500 a month, 21% between $500 and $1,000 a month. So when you think about this, from the ability to have some liquidity in the monthly budget, whether that's emergency savings, retirement savings, paying down debt, or just providing childcare, this is a significant pinch for most borrowers.
I mean, we're also in a state of reskilling within the labor market right now. And so this might have an overarching impact as well, or at least a permeating impact on the thought process of whether or not you would pursue additional education. I mean, are you seeing that show up as well in some of these figures?
Right. Well, 2/3 are actually satisfied with the education that they've received, and 1 in 3 are saying they are less likely to pursue that additional education. When we asked this question last fall, 47% were saying they were less likely to pursue. So that has improved. But truly what it comes down to is what you owe. Essentially, the higher the balance means the less likely you are to continue that education. This is an investment in self. I was the first person in my family to go to college and had student loans for many years, but the value still holds. The Social Security Administration data show that people with a 4-year degree are going to earn a median somewhere between $630,000 and $900,000 more over the course of their lifetime. So exploring this from a return on investment, the cost of the degree versus the earning potential needs to be considered overall. But it doesn't mean that your first several years into your career are not going to be a true stretch and a struggle.
What do you believe those who are holding student loans or those who are in the middle of their college decision process or even within their education right now, what do you think they would like to hear from candidates leading into the general election as to how they will approach cost of tuition more broadly, the payoff there afterwards as well, and what needs to be discussed among both sides of the political aisle?
Right. Well, this is truly a central issue for borrowers across the board. Over 60% of borrowers say that the topic of student loans should be a major platform consideration for both candidates. This tens of millions of people and potential voters. This is paramount for them. Further, in no age or political demographic does that opinion fall under 50%. It's as high as 80% for those under 25 and 70% for those 25 to 34. And this holds regardless of political affiliation. So the candidates should be paying attention to these voters and bringing policy recommendations and solutions to the table.
Billy Hensley, who is the CEO and president of the National Endowment for Financial Education. Billy, thanks so much for taking the time here with us today. Very important conversation.
Thank you.
Certainly. In an increasingly digitized era of banking, JPMorgan Chase plans to plant more brick-and-mortar roots. The firm announced plans to hire 75 community managers and expand its network of senior business consultants from 35 to 38 cities by the end of the year. Furthermore, according to the Wall Street Journal, the bank's CEO, Jamie Dimon, has plans to open nearly 100 new branches in low-income areas across the country. But these locations will be more than just a place to cash in on those checks. They'll include spaces where the public can attend small business and financial education workshops organized and run by JP Morgan. The bank wants to offer an alternative to check cashers and payday lenders, which often charge high fees for folks cashing their paychecks. The company has already piloted a few branches in this model. The first site was opened 5 years ago in Harlem. JPMorgan Chase is one of several banks with plans to open more physical sites. You've got Bank of America, PNC Financial Services, and regional lender Fifth Third Bank have all recently announced plans to open more branches. After years of focusing more on digital offerings, banks now see physical branches as a place where customers can get financial advice and build or reestablish a real relationship with their company. Coming up, Tesla deliveries are out today. We break down what they say about the state of the consumer and the overall electric vehicle demand. That's right after the break. Stick with us. Tesla deliveries coming in slightly below estimates, but posting its first increase in quarterly vehicle sales this year. Are more consumers plugging into the EV story? To discuss, we've got Carl Brower, who is the ICCars.com executive analyst. Carl, great to have you back on the program with us. All right, so let's talk through the difference that we're seeing here and how Tesla is operating right now, and what most notably is key for them in this larger electric vehicle landscape.
Absolutely. You know, they've been the big player for so many years, and we've seen tremendous growth for much of that history, certainly in the last few years. I think the challenges they're facing now clearly are in continuing that growth rate. They're higher than they were last Q3, but year to date, they're still down. And the concept of Tesla not growing sales is kind of a new concept, I think, both for the company and a lot of the fans and the investors. And I think Elon is realizing clearly that he's not going to have the growth rate he had before. And more importantly, he's not going to have the profit that he had before. There's also just more competition, particularly from China, which has lower cost structures. So he needs a paradigm shift. And for years, we've heard that this is a tech company, not a car company. That's why its valuation is so much higher than traditional car companies. I think it's time to prove that. And the robo-taxi discussion he's going to have this month and progress in that area is really where his future lies.
With that in mind, I mean, it's the 3 and the Y right now that really account for so much of the production and the delivery, and there's the synergies that the 3 and the Y have, where 75% of the Model Y is really just a Model 3. And so all of these things continue going forward. What type of reliance is Tesla going to have to extract from other parts of the business? I mean, Cybertruck's not going to take over the type of sales that we're seeing among the mass market vehicles that they offer, but is the robo-taxi really the thing that investors, that people should be hanging their hats on here?
You know, robo-taxi could be a game changer. I mean, whatever company, there's Waymo, there's plenty of companies out there trying Cruise. They're trying to come up with this self-driving tech. And when that hits, it's not an if, it's a when. It's going to be a game changer. I think it'll be along the lines of like when the internet became a part of people's lives, because the kind of commerce and business models that can grow up around self-driving tech and how it'll impact people's lives is huge. However, it's not going to happen overnight. And if Tesla, for instance, were the first to breach that barrier, that's going to be very tough to get through, and have a consistent, safe, self-driving taxi, even if he announced on October 10th next week that it's ready for prime time, that could be his position. But it's going to take years of regulation to get these things ramped up and have them out there in a meaningful volume and have a meaningful impact on actual use. So I think if he could make that kind of progress, you'd see the stock price go up in anticipation of the future. But it's going to take years for any company, including Tesla, to actually go from having the technology ready to having it impacting their people's lives and the bottom line for the company.
Carl, with the time that I have left, I got to go rapid fire here. I want to squeeze 2 topics in. Most notably, I mean, there's a major kind of range of thought processes going into the car buying experience. What do you believe that it is moving the needle right now, whether that's among people who are looking to purchase an electric vehicle or those who are looking to purchase a standard ICE combustion engine, if you will?
You know, there's a lot of macroeconomic factors, everything from inflation, which has reduced consumer spending power, to interest rates, which has made cars more expensive to finance, just like houses. And we've seen the rates coming down. That should help a little bit. I was watching your jobs report. There was some positive news there. I think we're going to need to see, some confidence in the future. I think a lot of people are waiting for a rather big event about a month from now to see what happens there. So I think there's a lot of people kind of waiting on hold right now to make any big moves. And that's what you're seeing in these dropping new and used car sales activity. Hopefully that'll get turned around.
And within that, who's performing? Who's outperforming, I should say? I mean, is it the companies who do well at putting a mass market vehicle into the market, or is it those that have seen on the luxury end the consumer still willing, or at least having the cash to be able to spend if they did want to change over or trade in, trade up to a new vehicle?
Definitely the luxury side has done better because those consumers aren't as concerned about their financial situation. I was just at a Genesis event, the luxury Korean brand, and they're hitting record sales this year. So they're doing really well. And we're seeing that in general across the luxury divisions. It's tougher for the mainstream brands because the mainstream buyer is a little more hesitant right now.
Carl, great to see you here. Carl Brauer, who is the iSeeCars.com executive analyst. Great to have you on the program.
Thank you.
Coming up, everyone, we break down what you need to know to set up your portfolio for success in the fourth quarter right after the break. China stocks rallying this week as stimulus boosts investor optimism on the country's markets here. Now, if you want to play in the China trade without cashing into specific names, ETFs might be the way to go. As part of this week's ETF report brought to you by Invesco QQQ, we've got Todd Rosenbluth, who is the VettaFi head of research. Todd, great to have you back on the program here with us. All right, so I know you have been tracking the stimulus that has been thrust into the economy in China, and now investors are trying to figure out, okay, what is the trade that they should or could be initiating? On an ETF perspective, how does that play out?
So for much of the year, China has underperformed the broader emerging markets. And so investors actually had been gravitating towards these ex-China ETFs. There are ETFs that offer emerging market exposure, but strip out China. So iShares has a popular product, EMXC. State Street actually recently launched a ex-China ETF. But this China stimulus that we're talking about could be the necessary boost to get more investors focusing on China. The Chinese stock market did very well in the past month. So an ETF like GXC, that's the Spider S&P China ETF. That's a broad market exposure ETF. You have the opportunity to get China A shares. You get exposure to the broader Chinese stock market, industrials, financials, as well as the more growth-oriented sectors. And then KWEB, which is the Crane Shares ETF, the China Internet version that they have. And KWEB is targeted towards what you would imagine, the Alibabas, the Baidus, the Tencents, that are the well-known names, and many others that give you exposure to those faster growing companies in China. So we think many investors have been underexposed to China this year. Now is a great opportunity using ETFs, get the benefits of diversification to tap into some of those ETFs.
With that in mind, are there ETFs that actually hold US-based companies with the more outsized exposure into China based on either their revenue or just the percentage of business that they do in the region?
So I'm not familiar with ones that are specifically focused on China, but you certainly are going to get more exposure with your large cap oriented strategies. So large cap companies in the US have multinational exposure. Apple is, of course, getting some of its revenue from China, so is Microsoft, and those are part of the S&P 500. But we at VettaFi think we're going to see actually a shift and some favoring towards small and mid-cap strategies in the fourth quarter, given that we've seen the beginning of a multi-rate cut cycle.
Todd, while we have you here, we've also been tracking, of course, the port strikes as well. And a lot of investors might be wondering if there is even an ETF play when you're considering what's taking place at the ports and ultimately the labor negotiations that are playing out.
So this is obviously going to have probably a negative impact across the economy. And I'm not qualified to tell you the levels of depth that it's going to impact the economy. But what I would say is that there's an ETF likely for many things, and there are transportation-oriented ETFs. So the iShares US Transportation ETF, IYT, is the largest of those transportation-oriented ETFs. And you can look inside the portfolio of this and another one from State Street, and maybe I'll get to in a second. But IYT, you can see the sub-industry breakdown as to their exposure to cargo, their exposure to ground transportation, passenger transportation, airlines, railroads. The other ETF, just so I make sure I get it in, is from State Street. It's the Spider S&P Transportation ETF, XTN. Now, the major difference between these two is that XTN is equally weighted, so it has more exposure to those small and mid-cap companies that I was alluding to earlier that could benefit from the economic efforts that from the Fed cutting interest rates, whereas IYT is more market cap weighted. And so Uber is actually the largest holding in IYT.
Todd, I always say it every time. One day we're just going to have a jam session, plug in that guitar, put the 1/4-inch jack in and plug it up to an amplifier. That day is not today, but
I'll bring my guitar next time to the studio.
There we go. Todd Rosenbluth, VettaFi head of research. Thanks so much for taking the time.
Thank you.
There are many things to consider when allocating your capital, including active and passive investment strategies, both with their own benefits and risks. Joining me now to break it all down, we've got Roger Aliaga Diaz, who is the Vanguard Global Head of Portfolio Construction. Great to have you here with us. So break this down for us, especially as we're considering some of these investing strategies. Where are you seeing investors lean towards right now as we are entering into the fourth quarter of 2024?
Well, investors usually try to weigh the benefits of active and passive based on kind of the expectation for the active managers. There is no really better environments for active, to be frank. I mean, each environment has its own challenges. Usually in election years or around Fed moves, those are periods in which perhaps some active managers can add value to the portfolios as opposed to investors trying to play those events in terms of asset allocation. So I would say in general, these are periods in which active management can add value definitely in the portfolio. The question is how much, right? How much of the portfolio into active management, how much in a strategic passive position.
What are the factors that investors should consider when making a decision in how to construct an active versus passive portfolio?
Yeah, look, traditionally, investors have always thought in terms of outperformance. Can active managers beat the market, outperform, right? And that has led traditionally to a more of a binary choice, all or nothing. If you think that your active manager is going to outperform, go 100% active. And if you're more of passive, like more saying active managers cannot outperform, you go 100% passive. But what we propose in the Vanguard framework for active passive is more of a blend as you start thinking about the probability of outperformance as opposed to a certainty. So every manager may outperform on average, but in any 1 month may actually underperform, right? So there is more of a risk-return trade-off, like in the same way stocks and bonds. There is a risk-return trade-off. Your active manager gives you upside, but there is risk of underperformance, right? And then the other factor, in addition to the risk-return trade-off, is the risk tolerance of investors. We have to keep that in mind. There are investors that are more open and more patient, right, to tolerate periods of underperformance that comes with active management. So as you factor those things in a framework, you can come up with an optimal blend, right, like a best blend of active and passive in the portfolio, where you diversify the risk, but you still got some upside for that active management. And that blend does depend on each active manager, right? There is no one-size-fits-all solution, right? It depends on the profile of the active manager.
You know, we just came off of a month where we saw some new all-time highs for the markets. So what type of risk propensity are you seeing among active versus passive portfolio managers right now?
Yeah, no, definitely managers in the stock market, they're having a little bit more challenge, right? As a benchmarking against the equity market. I mean, there is only one play, right? Remember, active managers add value by selecting security, by betting securities in a different way than the market. And when all the market performance is driven from one sector in particular, it's kind of very difficult to bet against that, right? So you will see managers that are more diversified, that they are less concentrated. They have a place like wider bets in a market that is really rising. In a sideways market, you could see more active managers taking a little bit more risk. And fixed income space could be a little bit different because we are a little bit in a juncture. So that's where it could be more interesting to think about active management positioning.
Roger Aliaga Diaz, who is the Vanguard Global Head of Portfolio Construction. Thanks so much for taking the time.
Good to be here. Thanks.
Coming up, everyone, the 30-year fixed rate mortgage is at its lowest level in 2 years. So, big question, is now the time to shell out your down payment and buy that home that you've been dreaming of? We've got more on that on the break, after the break. As the Federal Reserve starts its rate-cutting cycle, many Americans are wondering whether now is the time to buy a new house. And that got us thinking, when is the best time to buy? Is there a particular season or time that's better for buying? Here with some of those answers, we've got Yahoo Finance's Danny Romero back here on set with us to break this down. All right, so Danny, when is the best time?
Brad, fall is technically the best time.
Okay.
Realtor.com says that the best time to buy a home is starting the week of September 29th through October 5th. And the 2 weeks following are also very favorable as well. And so during this time, we'll see active listings significantly increase compared to last year. Historically, the first week of October, active listings jump about 37% from the start of the year. Buyers could save as much as $14,000 during this period in October. There's also less competition. Realtor.com said that about 30% fewer buyers are really looking for a home during this time.
And so, Danny, as we're taking a look at the 30 and 15-year fixed-rate mortgages, we know how much those have declined. I also do, though, want to pivot to some of the fallout from Hurricane Helene. So many people have had their homes destroyed here. Agencies are still calculating the economic losses. Moody's analysts, they estimated over the weekend that we'd see up to $26 billion in property damage alone. What kind of financial aid or relief can homeowners expect after a disaster like this?
This is a time of uncertainty, but Freddie Mac, Fannie Mae, U.S. Department of Housing and Urban Development, and the Veteran Affairs have come forward and said that they are going to be providing mortgage relief for homeowners who were impacted by the hurricane. For example, Fannie Mae said homeowners affected by the disaster are eligible to reduce or suspend their mortgage payments for up to 12 months by entering a forbearance plan with their mortgage provider. Remember, every mortgage provider has a different guideline, so please reach out to your mortgage provider for any assistance.
All right, Danny, thanks so much for breaking that down here. And then additionally here, in the wake of Hurricane Helene, many people might be looking for financial assistance. People have lost their homes and are displaced without their belongings. A handful of studies found that when people get assistance after a natural or personal disaster, they are more likely to avoid bankruptcy, keep their debt under control, go back to work, and increase their earnings. Here with more, we've got Yahoo Finance senior columnist Jana Herron. Jana, thanks so much for hopping on this specifically. We were just discussing before the segment some of the images that we saw. So ultimately, what do we know so far about getting some of the disaster assistance right now?
Yeah, thanks, Brad. Unfortunately, these studies are very relevant right now, but also instructive. So the first study that I looked at, after a hurricane, homeowners who received federal disaster loans were financially more resilient than those who didn't. Specifically, their likelihood for filing bankruptcy went down 61%. They missed fewer debt payments, and 3 years later, they were able to take out a new auto loan. A second study that looked at tornadoes, comparing households that received federal grants to those that did not, had similar findings. Those who received the aid had 30% less credit card debt. Financially constrained households were less likely to miss bill payments, and their spending didn't change. It didn't go down. And that last point is very important because that spending propped up their communities, where local businesses were able to survive at a greater rate and employ more people after the tornado.
Now, Jana, those were studies based on natural disasters. So what about personal catastrophes? How does aid help in those situations?
You're absolutely right. So a disaster doesn't have to be necessarily a hurricane or a tornado. Losing your job, getting your hours cut back, that's a very big disaster for many people. And a third study found that people facing eviction because of these kinds of situations but got small one-time grants for their housing really benefited. They were more likely to stay in the workforce. And for the lowest earners, that housing aid led to a small increase in earnings down the road. And that's not all. Again, the communities also benefited. Housing aid reduced how much these folks relied on homeless shelters and reduced violent crime.
Right, and so there might be people who actually respond in both natural and personal disasters and say, why don't these people have emergency funds or insurance? What do you say to that?
Of course, everyone should try to save for an emergency, but let's be real, some people live a lot closer to the edge than others, and so it's harder to do that. And sometimes you have an emergency and then one right after another, and you don't have enough time to refill your coffers. And in the study with the hurricanes, those homeowners had insurance, but it only covered less than half of the total damages, so that's a big gap. So I think the big takeaway here is that providing this aid is not throwing good money after bad. It's quite the opposite. Both individuals and communities benefit. It's a societal good.
All right, Yahoo Finance's own Jenna Herron. Jenna, thanks so much for breaking this down for us.
Thanks.
Appreciate it. Everyone, that's it for Wealth. I'm Brad Smith. Thank you so much for watching today. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. They've got you coming up at 3 p.m. Eastern Time. They'll count you down to and through the market close. You don't want to miss it.